Good morning, everybody. Excuse me. Morning and welcome to the education room, guys. Hey, Steve, good to see you. Everybody hear me okay? I triple clicked my microphone. I want to make sure it's on for you guys. Awesome. Well, welcome to the room. It's good to have you guys here. I'm going to start leading with this picture every day because I think it's important to remind yourself that in the beginning, it feels like a lot coming at you in this room. By day 3, everything clicks and you start to move forward, guys. The less, this is going to sound weird, the less that you try to find everything and the more that you try to find the best things, the sooner this goes away. And that's what this class is designed to do, guys. This class is designed mostly to simplify one basic process to give you what you need and give you the opportunity to grow from that little foundation. So we're going to have a great day today. I'm excited about it. Every morning I stop at forexfactory.com. I check the date. I see what's going on. We had some high impact and some medium impact news at 8:30 a.m. It didn't really do much to the market. Not a lot of movement, but the potential is there. Anytime there is a high impact news release, anytime there's a medium impact news release, you can say to yourself, man, the market might go a little crazy. I need to protect myself. Maybe I choose not to trade. It's really up to you what you want to do. A lot of the prop firms won't let you trade into news because of the emotional response. Slippage is a very real possibility. Good morning, Cav. Everything that I talk about this morning, yesterday, tomorrow, everything comes from the Nexgen page, guys. I go to great lengths, hey, good morning, Adriana, to not keep any secrets from you guys. So if I go to the trading guide, it's just that. It's a trading guide. Inside of here, there is the trading plan, everything that I talk about in the room, all the answers. Everything that I discuss is in this trading plan, but the trading plan on the website's probably even a little more advanced. I simplify. I pull things back a lot. I take a lot out that isn't necessary for the new user, and I really focus on simplicity. If you go to the frequently asked questions here, everybody close your eyes. I'm going to scroll down to the definition. Our first hour in this room, every day, and it's been consistent for years, is focused on what we call a high probability trade, specifically a high probability trend trade. Trading with an already established trend. A high probability trade is defined as a trade when each indicator on every chart agrees with the rules for the trade. You're going to have the strongest triggers and there will be nothing in the way, no termination conditions, nothing between you and your target. We focus on this highest probability trade because this is a trade that when you follow the rules typically wins 70 to 80% of the time. It's not a trade that happens 50 times every day. Some days you may see it 3 times, 2 times. Some days you may see it 10 times. It just depends on the day and how the market is trending. But what this high probability trade does for you, because of its potential for such a high win percentage, it creates a level of confidence. And confidence is huge in day trading because when you believe in and you trust your methodology, you tend to not hesitate. You tend to keep yourself in the best position because all you're doing is trading advantages, and that's what the high probability trend trade is. It's a description of having advantages in the market, turning those advantages into a trade. The most important reason that we talk about this trade first is because this is the trade that's going to teach you to read your indicators. This is the trade that's going to teach you to read your charts, to take the information, to decide whether or not you have the advantages you need to take that high probability trend trade. I was having a discussion with somebody yesterday and they asked me, like, well, what do you do? And I said, well, I teach people to read indicators. I made no reference to day trading. I made no reference to futures. I said I teach people how to read indicators so that they can recognize advantages. I said that's my whole job every day is teaching you guys to read indicators because chart reading is about 90% of your day every day. Chart reading is just looking at these indicators and saying to yourself out loud, I have the advantages I need to enter this trade. Chart reading, guys, is what creates the foundation. And once you're good at it, once you can take some very basic concepts and make them second nature, you'll understand where the market is likely to continue, and this becomes your entry for the highest probability trend trade that you can take. You'll understand where the market is likely to go, and this is going to help you with profits, putting your profits in the right spot. And you're going to understand where the market is likely to stop. And these likely to stop areas are what we call termination conditions. And one of the biggest advantages Nexgen offers you is you'll understand where the market may stop, where it may reverse, where fights may happen, where the people that control the market are making decisions, and it's going to stick out like a sore thumb at you, and you're going to be able to make the decision to not trade into these key areas with some very simple rules. We focus on this highest probability trend trade. This is all I'm going to talk about for the first hour, and even more so, we're going to break it down into its 3 rules. We're not going to talk about making money for the first hour. We're going to talk about recognizing advantages, because advantages are why we enter a trade. Each rule for the high probability trend trade, the rules are in white, creates an advantage. The advantages are in yellow. So a trade is having those 3 advantages. A trade is taking momentum from strong triggers, coupling it with a clear path, meaning that there's none of those likely to stop areas in the way, and then just defining your entry, getting into the market where the market is most likely to continue with the trend. These 3 rules will be broken down individually. These 3 rules will be the foundation of what you're doing, specifically the first 2 rules. Once you understand momentum and path, once you can identify strong triggers, and once you can identify termination conditions, you have everything that you need for a very successful, very consistent trading plan. So I want you to focus on these things individually and make sure that you give them the attention they need. Trina, good morning. Welcome to the room. Wayne said he is sure you can teach old dog new tricks. Trina, I will do my best. If you'll do me a favor, just forget what you know. Give me 2 days, blank slate, and let's focus on identifying momentum and clear path, and you'll take those old tricks that you have, and you'll find a way to combine them and get those advantages in the market. And ask a million questions, Trina. Do not hold back. And I love that there's a smiley face at the end of your name. These 3 rules happen on only 2 charts. Simplicity. One of my favorite quotes from Elon Musk is he struggles with engineers because engineers are always trying to optimize things that shouldn't have existed in the first place. And I think when we come into the high probability trend trade, a lot of us try to optimize it. We try to add things, our own little twists. And I'm telling you guys, if you allow it to be simple first, you'll find your twist. You'll find your way. So let's let the large chart be the reason that we enter a trade. So the large chart, this is your workspace, is a very slow moving chart. I like to think of it as a broad stroke of a brush. You're painting your living room walls. You're not worried about floorboards or around light sockets yet. So your large chart is going to define the direction of the market. It will let you know that you have the advantage of momentum through rule number 1, and it'll make sure that you're not trading into areas that could stop the market. That's rule number 2, assuring you have a clear path. So direction, momentum, and areas are defined on the large chart, and you're going to be able to do it with the first bar. Whatever bar is printing first, you'll have all the information that you need. Remember, this is a very slow moving chart. It's hard to see change on this chart. When these rules are met, when you have momentum, when your path is clear, you'll turn your attention to a smaller chart, and this is a faster chart. This is a refinement chart. You're going to be able to see the inner workings of just one bar, You're going to see probably a pullback. You're going to see a bounce at an area. You're going to see continuation with the trend. Your small chart's going to look like it's busy. Your large chart isn't going to budge. And it's that refinement process on the small chart that allows us to really pinpoint these entries, to reduce our risk and really maximize our profit potential. Rule number 3, the entry for the high probability trend trade happens on a small chart after the first 2 advantages are in play. So your foundation is a 1 chart foundation. Entries are going to show themselves once you understand that. We use these 2 charts. I see a lot of new names in here. Good morning, new people. And good morning, old people. But good morning, new people. Welcome to the education room. The first hour feels like a lecture. I understand that completely. The second hour, good morning, Jerry. Guys, it's a discussion. There are no limits on the numbers of questions you can ask. There are no limits on the number of pictures you can post. Really become active in this room. Let me see what you see. Tell me what you're thinking. And guys, there's no doubt in my mind, with a little bit of participation, everybody gets to where they want to be. I just wanted to throw that in. It's great to have you guys here. The 2 charts, this is your metaphor. Who are you trading with, or who are you trading against? Hopefully nobody has any idea that they control the market. Hopefully you know that you're just along for the ride. Your large chart is the large crowd. This is all the people with the money, the influence. They create trends, they establish momentum, they react at key areas. And trading with the large crowd typically wins. Going with the flow, guys. But then your small chart's like this small crowd. And the small crowd has a lot of money. And they can create retracements and pushbacks and fights against everything that the large crowd wants. But the small crowd typically fails 70 to 80% of the time when the large chart rules are true. Which means that when we enter on that small chart, we're entering right where the small crowd is most likely to fail. We're actually entering right where that trend is most likely to continue and go the other direction. That's the magic of rule number 3. So we love the small crowd. We need their fight. We want their fight. That's what's going to get us into the market. But we're going to trade with the large crowd. We're going to go with that big slow chart and really just embrace their advantages and hope for the best. This is your path. So if you're new with me, Trina, Jerry, BYU, guys, this is your path. This path has been consistent with Nexgen since chat rooms were a thing. Post your trades in the room. Show me everything that you're doing. And it doesn't matter if it's wrong. And to be honest with you, if you're brand new, I kind of want you to be wrong. Because we all make mistakes in trading, in life, whatever. We're human. But it's learning from those mistakes, and I don't want you to feel the burden of having to fix things yourself, guys. Give me the opportunity to fix them. Every time you post in the room, it's a private session with me. The first hour, you can post all you want. The second hour, we're going to look at your charts in the order they were posted. We're going to talk about them in regards to advantages. We're going to see if the chart read is accurate. We're going to make sure that your entries made sense. We're going to make sure that your exits made sense. And if there is anything that I can do from my 5.5 years of experience with these indicators, I'll give you everything I have rattling around my brain. On the 17th, Walter, they rolled last week, so you should be on the new month of crude by now. Yeah, you're welcome. So our first hour is dedicated to learning the trigger line and the Fibonacci rules for when it's okay to trade. We're just dedicated to, if our rules are met, we enter the trade. We have an advantage, we have an edge, and there's no reason not to take this trade because it's a pattern that's been proven to win more than it loses. When the rules are not met, when those advantages are not in place, that's when we sit on our hands. That's our 90%. You'll find that you'll understand the movement of the market through these patterns. These patterns repeat themselves every day. So practice the rules. Practice learning these trades. Practice getting in, getting out, moving stops, scaling charts. Guys, just get in there and break stuff. But post in the room. Hey Mark, this is what I did. I'm not sure why. What do you see? We'll talk about it. The goal is that you always have the correct rules. That's everybody's goal, to getting to the point where they always enter the market when the rules are met. I'm going to tell you, I'm human, you're human. We're going to fudge those rules a little bit, but if you post them in the room, we'll talk about what went wrong. We'll talk about how to fix it, and together we'll work to get you to the other side of any challenges that you're having. We're going to simplify. I've said that word 1,000 times in the last week. I'm going to give you a rock solid plan. It's going to have 2 trades on it. The first trade will be the high probability trade. The second trade will be what we call a medium probability trade, and that's probably going to be the trade you take the most of, but it's your chart reading that's going to set you up to take that trade. So let's keep it very basic, understanding that you are on the brink of all the greatness that this software offers. You need to know what you're going to look for. What does it look like when your pattern is met? What does it look like when your rules are true? That's where the spreadsheet comes in, because we're going to learn these looks and they're going to become easy. And they will slow down the market, and it's almost like leading the passer. If you're the all-star quarterback, you're going to call your shots. And you're going to call your shots long before the entry ever happens, and you're literally just going to sit there and wait for your entry. That's the accuracy that you guys are about to have. The spreadsheet that I share with you guys every day, this is going to help get you there sooner than later. There are 4 tabs on this spreadsheet. I just dropped it in the room. For those of you that aren't super computer savvy like me, so there's, whoops. So here's our chat room, and I just dropped the tracking sheet in there. You can download it, send it over to your downloads folder. You can also just click on it and go drop it into a file if you want. Drag it over to a desktop, but grab that spreadsheet. There's also one in your Nexgen Study Picks folder. But these 4 tabs, each one has its own role. The first one, in green, are pictures of having rules 1 and 2 met. Pictures of what it looks like to have the advantage. And every picture is annotated with the words that describe why the rule is true. I'm going to give you something, a little study guide that's going to help you fill this out with some of your own pictures. In the red, or the salmon, if you will, are what it looks like to not have your rules met. This, you could call this the 90%. This is when you're going to pause, when you're going to wait, when you're going to say to yourself, I don't have those strong triggers, they're weak. Let me sit on my hands for a second and let the large crowd throw a little giddy up in the market. So knowing the difference between rules met and rules not met is going to keep you out of a lot of avoidable losers. The second tab is the client trades. And man, I appreciate you guys for these. You guys post amazing trades in this room, embracing those advantages. You annotate the charts, why you did what you did. When they fit that very core plan of the high probability trend trade or that medium probability trade, guys, I steal them and I drop them in here. And there's probably more now, more than 400 pictures. And it just bugs me that that's not green yet. Hold on. There we go. I feel so much better. And they're all in here for you to study. You can come back and you can look at these. If you have questions about them, you can post that picture in the room and go, Mark, talk me through what they were thinking here. But this is going to help create that recognition through repetition, seeing the same thing repeatedly. There is the entry sequence. When we get to that small chart, defining that point where the market is most likely to continue, broken down for both long and shorts. Some people want to be NASDAQ traders. NASDAQ moves about 10 times faster than crude oil or the S&P, which is why I teach on crude oil and S&P. But once you know your rules and you begin to understand right where your entries are, NASDAQ is actually tradable, and there is a lot of opportunity, but there's some little things that you have to do just a little bit differently. So this is for my NASDAQ traders. I'm always willing to talk about it in the room. Just show me what you're doing and we'll talk through it. There's the management section. On the plan I give you, these first 4 pictures are what it looks like to manage your high probability trend trade in the most mechanical, emotionless way possible. And then when you get better with the software, you'll find different ways to manage, ways to hold for bigger moves, reasons to exit a little sooner. And then patterns that repeat themselves. When you understand momentum and you understand path, you're going to start to see things. You're going to start to see the same patterns repeating themselves in the market, because that's all the market does. It has a memory. Start taking pictures of them. And what you'll find is that these patterns that you see are the foundation for your trading plan, not the one that I hand you, but the one that you're building for yourself. And that's what the third tab is. Start taking your pictures, drop them in here, fill this thing out, guys. Make it look like the client's trade section. The people that take the most pictures, that annotate the most charts, that drop the most charts in this room, these are the people that typically get to where they want to be the fastest. There's an easy way and a hard way. I've done the hard way. This class is dedicated to letting you guys kind of bypass a lot of the pitfalls that I've had. If you take 15 pictures a day, annotate them. And guys, that's not a lot of pictures. 15 pictures a day is 300 pictures a month. That first 30 days with Nexgen, you could have 300 pictures. By the end of 90 days, you'll be 1,000 pictures deep. I always like to share this with new users because it sounds like a lot of busy work, but the reality is in 2025 already, I've taken 1,163 pictures. Annotated most of them, and they're not just all the pictures from the class. That's my own personal study. It's my own personal trading. It's patterns that I'm working on. So the more pictures you take, the quicker recognition comes. Fill this out. So we're going to learn the rules. You guys have the ability to simulate, zero risk, practice, drop it in the room, get feedback on everything that you do. The easiest way to get feedback, I'm going to put this in the room, is every time you take a trade, win, lose, or draw, the only thing we're doing is we're figuring out what you did right and what you did wrong, and then working together to correct anything that needs correcting. And really, we're going to high five and praise all the stuff that you do well. But if you talk about each rule individually, point them out, let me know what your chart read was, show me where you entered, show me where you exit. And what happens is we're going to talk, make sure that your chart reads are accurate, make sure that your entries are the lowest risk, make sure that your exits make the most sense based on key areas. And we're just going to do that until you get to where you want to be. So we're going to learn it, you're going to practice it, we're going to simplify, guys. And this is our goal. So for you brand new users, here comes the good stuff. What am I looking at when I open up my charts? What are those darn squiggly lines, guys? These are your trigger lines. Trigger lines will show up on both the large chart and the small chart. Trigger lines do an awful lot for us as Nexgen users. There are two sets of triggers. There are small triggers, and the small triggers are the solid lines. They're always the solid lines. They're a fast-moving average, and there's large triggers, and the large triggers are a slow-moving average. All you have to know is the difference between the two. You don't have to know how they came to be or who created them or what the average is or how can I change the colors. All you have to know is that they are small and they are large. And we're going to let them define momentum. We're going to let them define termination conditions, and we're going to let them define entries, guys. Trigger lines come into everything that you do. Areas are on both charts as well. 99% of your areas are nothing more than a horizontal line. There's a divergence high. It'll be magenta. It will print from a pivot if there was a loss of momentum at that pivot. So if the market is screaming up, buyers are in control, sellers reverse it, steal it, you're going to see a pink line, magenta line. Same thing at a low, but you'll see it blue. You're going to see Fibonacci resistance, always the red line, horizontal. You're going to see Fibonacci support. These are called yellow 1-to-1s. It's just a 100% Fibonacci alternate. And then we've also got the mid-band. In the mid-band's just a moving average as well, and it goes through the center of the chart. You'll notice that if price is above it, it's green. If price is below it, it's magenta. Nexgen loves colors because colors really help. They simplify a lot. So let's get into the rules. I want you to interrupt me if you have a question. I really want you to interrupt me if you have a question. Hell, I want you to interrupt me even if you don't. Let's see if I get mad. I don't think I will. Large chart leads the way. Large chart tells me which direction I should be trading, guys. Large chart must have strong trigger lines. This is rule number 1. That's going to give us the advantage of momentum. So let's define trend first. Remember, the trend is your friend. We've all heard that one. Trina, old dog, you've heard trend is your friend. Let's see how we can use it. If the background is green, market's going up. Let's look for rules to be met for high probability trend trades long. If the background is red, the market's going down. Let's look for rules to be met for high probability trend trade short. Big reminder here, this isn't the only thing that you can do, but in the first hour we talk about the absolutely positively highest chance of success for the new user, and trading with the trend offers that. When the background is green, the only way that I can have, oh, she said old dog new tricks, Wayne. I assumed that she'd been trading for a while. No worries. All right, so Trina, even better. No bad habits. So rule number 1 is ignore Wayne. Ignore Wayne. Wayne's brilliant and sees patterns outside of these very basics. So you keep it basic and don't try to be him. Guys, when we have strong a green background, when that trend is up, the only way that you can have strong triggers, the only way that rule number 1 is met, is if the small triggers are green. If the large triggers are green. So you want 3 of the same color: background, large triggers, small triggers. Background, large triggers, small triggers. Strong triggers means that your small triggers in an uptrend are above the large triggers, that there is space between the two. I want you to picture scissors that have just opened and are ready to cut. Once that separation starts, the odds are favorable for the market to continue up. In a downtrend, the small triggers below the large. Once the colors match, the separation, the odds are favorable for the market to continue down. Odds favorable momentum. Guys, you're going to see it annotated in this room, OFM. You're going to see charts with OFM. That's exactly what they're talking about. They're saying, Mark, I had the advantage of momentum in this trade. There it is, labeled OFM. Odds favorable momentum can push a market. But remember, we're going to learn the good and the bad. When my small triggers work their way back inside of the large triggers, when those scissors close, I have what's called weak triggers. And when I have weak triggers, anything can happen up or down. So let language kind of lead the way. Strong triggers, the market is likely to push. The odds are favorable for that trend to continue. Weak triggers, anything can happen. Guys, when I have the advantage of strong triggers, I like this picture. That separation lets me know that the market is likely to continue in the direction of the trend. When I have weak triggers, and this picture doesn't have the benefit of Fibonacci, notice that weak triggers is where that reversal seems to happen, where the market seems to change direction. Anything could have happened and something did. So we're looking for the odds favorable momentum, waiting for the large crowd to tell us that they have no intention of stopping. And then you get those times when the colors don't match, guys. This is when the both sides of the fence are fighting. The large crowd buyers, the large crowd sellers, they're duking it out. And you'll see that the colors of the triggers don't match one another, that the colors of the triggers don't match the background. And you're just going to say to yourself, my colors don't match. I don't have rule 1 met. I'm going to sit on my hands because eventually one of them are going to win that fight. Eventually they're going to break out of that little range and you're going to be able to take that trade. So strong triggers, it's a pretty easy look. Let me pull up a large chart real quick. When there is separation, there is strength. When there is no separation, there is weakness, guys. Can you give me a Y in the room if you're with me? Strong triggers pushes the market. Strong triggers can break key areas. Guys, strong triggers can cover a lot of the mistakes that we tend to make as new users. And here's the great thing about strong triggers. When I have strong triggers on my large chart, from the point of separation until they return, on a large chart, on a slow chart, you're going to see these tails or these wicks, and all it is that fight by the small crowd. It's that push down. It creates a tail. On your smaller, faster chart, these tails are typically pullbacks. These are your entries, and rule number 3 is designed to have you pinpoint where that tail is most likely to form. The tails are not your entry, whether it's an uptrend or a downtrend. You're going to get that on the refinement chart. But every time you see a tail with the rules met on the large chart, I want you to say to yourself, man, that tail, well, that might have been an entry on my smaller, faster chart. And we'll go back and look at this one after we do entries. And what you'll find is that these tails show up every now and then. And there's a little pause between them. But these are potential entries. And we're going to use this idea to be able to come back, study this methodology, create a little trust in it. So just on the first bar, my large triggers are green, but my small triggers are below them, not above them. Do I have rule number one met? Do I have strong triggers? Is there an advantage of momentum in this market currently as we see it? What do you guys think? No, perfect, Trina. You are already brilliant. I love it. That is always strength. Those triggers are on the wrong side to be considered strong. And look at the background. The background's red. The colors don't match. Colors are going to help. All right, triggers are good, strong. We have momentum. First advantage is in place, guys. So now let's make sure that there's not a brick wall in front of us. Let's make sure that there's not an area with the potential to stop the market, the potential to reverse the market. And those are called termination conditions. So this says termination false. Make sure that there's room to profit targets. And when that rule is met, you're going to have a clear path. So when you have momentum and nothing in the way, I want you to picture a semi going downhill with a tailwind, brakes are burnt up, and there's just nothing that's going to stop that. It's going to be hard to get that thing to stop. So what is a termination condition? It's a horizontal line on your large chart. These are where decisions are made. It is divergence high lines and divergence low lines. It's blue Fibonacci support. It's red Fibonacci resistance. It's yellow 1-to-1s. And it's even a mid-band if the large triggers are a full bar away. So the large chart is going to define areas that may reverse the market. And it's going to do it with a comparison between the area, the horizontal line, and those trigger lines. There's the trigger lines coming back into it. I want you to write this down if you're a note taker. Large crowd makes decisions at large chart key areas. Large crowd may buy, may sell, may fight, may reverse, may break at key areas, and you will never know what their decision is going to be. But to identify a termination condition, we're going to let them get to the line. So if the buyers are in control, the market is screaming up, everybody wants to go long. If price reaches Fibonacci resistance, if it reaches resistance, that could be a divergence high. It could be red Fibonacci resistance. It could be yellow 1-to-1s. But once price reaches the area, I just want you to ask yourself, where are my triggers? If your triggers remain below that area of resistance may stop the market. That area of resistance may create an untradeable bounce. That area of resistance may break. That area of resistance may reverse the market completely. And if it reverses the market completely, those large triggers go from green to red, we are going to call it a strong top. Strong top isn't mandatory for a high probability trend trade. It's not one of the rules. But when I do have a strong top, a no triggers through termination that reverses the market, if my rules are met for a trend trade after, that's the best of the best. That is the highest possibility of a win. So price reaches, where are my triggers? If they remain below, wait for the reaction. Wait to see what the large crowd's going to do. Here they reverse it. The momentum is strong. And then price reaches Fibonacci support. It could be a blue line. It could be a divergence low. It could be a yellow 1-to-1. When price reaches support, where are my triggers? They remain above. Support is a termination condition. It could create an untradeable bounce. There could be a fight between buyers and sellers there. It could break, or it could completely reverse the market and become a strong bottom. But here is the key. If price reaches the area and the triggers remain below resistance or above support, no matter what the momentum is, rule number 2 is not met. No trades into the area. So let's go see if there's any validity to this. I love it. Price reaches yellow 1-to-1s and the triggers don't break, and look how the market reverses. Price reaches Fibonacci resistance, even with odds favorable momentum. Look how the market reverses. All the way down to those 1-to-1s, triggers don't break. Resistance creates a bounce. Support creates a bounce. The divergence high, triggers haven't broken, created a bounce. Do you guys see it? Decisions are made at key areas. The decision may be a little bounce and continuation, but it came right off of support. Came right off of support again. Right off of support again. Egads and little fishes. You guys know where highs and lows could be. You guys know exactly where decisions are most likely to be made. Learn the simple language to identify them and respect them. They hold more than they break. That's why it's a rule. Is everybody with me? Can you give me a why? Price reaches the area, triggers don't break. Let's sit on our hands. It's easier that way. Less stress. Well, areas break, guys. They break all the time. If they didn't, we'd be caught in a range. So this kind of shows what it looks like. Well, this not even kind of. This exactly shows what it looks like when an area breaks. Number 1, price reaches, triggers below. This is a termination condition. Wait for the reaction. Believe in your heart that you'll never know what the reaction's going to be. You'll think you know, but you don't. So just do nothing. And guys, every line that you hit, at least for a moment, is going to be a termination condition. Well, if your small triggers, both lines smash through the area, and let me emphasize that word smash, 2 to 3 points above resistance. Not little prairie dog peeking their head, but literally getting up above there. But those large triggers remain below as long as you have odds favorable momentum. Because odds favorable momentum gives the potential to break areas, you can say to yourself, this area has the potential to break. I can find opportunities with a medium probability trend trade, but since my path isn't clear yet, I'm going to manage this trade assertively. I'm going to use my chart reading and make sure that I don't hope for a home run when they're only giving up base hits. But once those small triggers and the large triggers, both lines of each, get above resistance, resistance is broken, and now it's in your rearview mirror. Resistance actually begins to behave as support. And what you'll find is that with that level of momentum, with that clear path, you're going to start looking for entries, and you're going to keep looking for entries until you reach the next line. And then when you reach the next line, the process starts over. Same thing happens going the other way. First, it's a termination. Sit on your hands. Take a break. Take a sip of your water. I'll do that right now. If the small triggers smash through, absolutely smash through, but the large triggers are being lazy, they're lagging, they're still above, this area has the potential to break because of the momentum, but because it's not broken, it's okay to manage assertively, to not hope for the big win, because it may not break, it's only potential. But once small and large, both lines of each get below support, support becomes resistance. Guys, your path is clear until you reach the next area. And I think we saw a great example of support breaking. Smalls and large got below, and look how it became resistance. Support broke, and it served as resistance. Let's see if we get another one here. Resistance broke, came back, behaved as support. Back as support. Pretty cool, right? You guys know where these areas are. All we're doing is we're kind of orchestrating this little plan to know when it's good to go and when it's not. There's going to be times where your areas are stacked, where your path isn't clear, where you're like, man, rule number 2 is keeping me out of this market. It's going without me. I'm not making any money. This sucks. And you're going to say that, even if that's not in your vernacular. Guys, this is 90% of your day. 90% of your day is sitting on your hands, doing nothing. You are going to be so much better than the person that has to hope an area breaks. You're going to know when it's broken. And guys, the futures markets, they exchange trillions of dollars every day. I think the last time I read it, it was $220 billion an hour are exchanged in the futures markets, you need to make $200 per contract on a 2-lot. You need to make $400 a day. That's it, to be in a 6-figure income with your trading. Think about that. $400, 4 base hits, 4 $100 trades. You're a 6-figure trader. So look for your opportunities. Trading away from areas. Look for your opportunities getting to the next area, and then learn how to pump the brakes. Learn how to sit still when it's time to sit still. The difference between the most successful traders I work with and the ones that seem to struggle are the ones that can do nothing when there's nothing to do, find the highest level of success. Who would have ever thought, man, I went to Nexgen, I want to be a day trader, and this guy's telling me to stay out of the market for 90% of the time. Crazy, isn't it? But it can be that easy. Play solitaire on the computer. So rule number 1, large chart has strong triggers. We have seen it, we've established it, it's been defined, we have the advantage. Large chart has no areas in the way that may stop the market. So we are loaded down and trucking, guys. We have all the momentum and the clear path, and I'm telling you, once you can identify these two quickly, you have everything you need to find all the trades. But we're going to find the entry for the high probability trend trade. We're going to go to the small chart, that fast chart, that refinement chart. 20 to 30 bars for every 1 bar on the large chart are going to print on the small chart. And your entry is going to be precise. You're going to be a sniper, guys. So much so that you're going to wait for the market to come to you with a limit order. You're going to use that limit order to buy or sell a pullback. And that pullback is the small crowd fight. That's a pullback. Everything over here says up and strong, and these yahoos are trying to make it go down. Thank goodness. Because we're going to buy that pullback. We're going to sell those pullbacks. And we're going to do it in an area. We're going to use a fib, a midband, or a yellow 1-to-1. The same way those could stop forward progress on the large chart, they can stop the small crowd's progress on a small chart. But here's the key. They need to be inside of triggers, guys. Your areas need to be inside of triggers because triggers are going to define where that pushback is most likely to go. One of the gospel truths is that price returns to large triggers. You can see that it pulls away from large triggers and it snaps back. And it pulls away from large triggers and it snaps back. And guys, this repeats itself throughout the day. There's one of those tails right on top of the large triggers. So on your entry chart, you've got large triggers and what we call synthetic triggers. And synthetic triggers are nothing more than the large triggers from the large chart. Because if price pulls back to the large triggers, there's 2 options with two charts. So from the highest point of the triggers to the lowest point of the triggers, guys, this is where the retracement is most likely to occur. This is where the accuracy starts to kick in. And you could make it even more accurate if you wait for what we call favorable large triggers. So to buy or sell a pullback at an area inside of favorable large triggers means that the large and synthetic are one on top of the other. That they are 2 snakes riding piggyback. Because now you have the smallest possible area for that market to retrace. Pretty cool to define it like that. And then when you put fibs, midbands, or yellow 1-to-1s in there to stop that small crowd's progress, you've got something to bounce off of and something to continue with the trend. So in one breath, we're going to say that we're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. This is where risk gets reduced and where accuracy is increased. So we're going to go through it. You'll notice that I blacked out the large chart. I'm using the large chart to just put all my typing because once I have momentum and a clear path, I'm done with the large chart, guys. That's it. I'm going to the small chart. I have triggers up. I have areas. Everything is screaming north. And my fear of missing out is beginning to kick in. And I'm saying to myself, man, they're going without me. I'm not making any money. Once again, stupid Nexgen keeping me out of the market. and then the small crowd fights. Then we get a reversal bar, and a reversal bar signals the beginning of the pullback. The reversal bar is not your entry. The reversal bar is actually kind of a loss of momentum on the small chart that hopefully is going to push us to our entries. So we know that price returns to the large triggers. I have large triggers and synthetic triggers, and the synthetic are stepped, but I'm going to be honest with you, it doesn't matter. They could both be smooth. You have two large triggers and price is likely to return to them. So from the highest point of those triggers to the lowest point of those large triggers, guys, this is where the retracement is most likely to occur. This is where the small crowd is most likely to fight. And the tighter they are on top of one another, the smaller this box is, the higher the accuracy is. So the first box defines where the market is most likely to retrace. Your second box will define where it's most likely to bounce, and that's the areas inside of those triggers. Fibs, mid-bands, or yellow 1-to-1s. So this box, from the highest area inside of triggers to the lowest area inside of triggers, this is where the market is most likely to bounce in the direction of the trend from the large chart. This is where the small crowd is most likely to fail, guys. This is where you're going to right-click and activate a limit order 2 ticks above that highest point of support. Some people ask me, well, Mark, couldn't you make more money if you went to the lowest point of support? Well, yeah, if it gets there. But remember that your large crowd, your large chart is screaming up with nothing in the way. Let's fight the urge to trip over a couple pennies to save a few dollars. Activate a limit order 2 ticks above. And then that's it. You have controlled everything you will ever be in control of. You don't get to determine whether there's an entry or whether there's a victory, but you've put your entry where the market is most likely to continue with the advantages that describe the pattern that has been proven to win more than it loses. And if the small crowd fights and hits that limit order, you're in a long position. You're hoping the market goes up, and you're hoping it goes up because you have the advantage of those strong triggers that tell you that it's most likely to go up. You have the advantage of no termination conditions, which tell you that there's nothing to create that untradeable bounce. And you have the advantage of having entered precisely where the market was most likely to continue with that trend. And guys, this is your entry. This is the high probability trend trade entry. This is the one that reduces risk. This is the one that maximizes profit potential. This is the one that once you can find this entry, you're going to start to see the rest of the opportunities in the market. So here it is, kind of start to finish. Reversal bar begins the pullback, the fight. That's not your entry. That lets you know it's time to go find our entry. So first we're going to define where the retracement is most likely to go from the highest point of the triggers to the lowest point of the triggers. And then you're going to define where it's most likely to bounce from the highest point of support to the lowest point of support. This is your window of opportunity. This is where the small crowd is most likely to fail, somewhere in this box. This is where the market is most likely to bounce and continue with the trend, somewhere in this box. We don't trade from somewhere in the box. We trade from 2 ticks above it because we don't want to miss this trade, not with all these advantages. In any line below the trigger lines, any line beyond the retracement zone, beyond the areas most likely to bounce, guys, this is outside of your window. This isn't part of the entry. Once you get to the wrong side of the triggers, there's no telling if or where that market's going to stop and bounce. Your advantage is gone. In a short trade, reversal bar begins the fight, not your entry. Trigger lines define the retracement, not your entry. Areas inside are where it's most likely to bounce. Your entry comes from 2 ticks below. One line inside of triggers, guys. How's that for accuracy? Any line beyond the triggers, beyond the retracement, beyond the bounce point, these are not a part of the window, guys. These are where your advantage is no longer in play, where your rules are no longer met. And you're going to use that idea because you're going to learn to call it where the market should not go. And stops are placed where the market should not go. Generally 4 to 5 ticks above all the trigger lines. If it's a short trade, 4 to 5 ticks below the trigger lines. If it's a long trade. And here's the deal. In order to get to your protective stop, the small crowd has to push through their retracement zone. They have to push through the areas inside of the retracement zone. And man, if they can get that done, I don't want to be in this trade. I want to be out of this trade. And anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. So if I take 10 high probability trend trades, guys, how many of those trades am I likely to lose? How many of those trades are just going to be a cost of doing business? A normal part of a positive equity curve. Is anyone good at math? I was an English lit major. If I take 10, I have to expect to lose what? 2 to 3? And I don't get to pick them, which means I have to be consistent. So let's talk about those tails. We don't trade tails, guys. My gosh, how could we trade a tail? That's ridiculous. It's a big, slow-moving chart. I don't know where that tail's going to work. But I do know that if I go back historically and circle that tail, and it lines up with an area inside of triggers, look how the boxes match. That was done on NinjaTrader. That's my entry. That's my entry with the absolute least amount of risk. That's the entry with the furthest distance to get to the next trouble. Guys, this is your high probability trend trade. This is how you're going to study it. Not even taking trades. Go back and circle tails. See if it fits your rules. Things I want new users to look out for. Don't define your termination conditions on a small chart. Termination conditions are defined on a large chart. Don't define your momentum on a small chart. Momentum is defined on a large chart. All you're defining on the small chart is where the market is most likely to continue and where the market should not go. So let's go back and let's take a look at that circle that we put on there earlier, and let's go see if that fit the rules. So as we look at that large chart, can you guys give me a Y if you see that we do in fact have strong triggers? Look at the separation between the smalls and large. Do you notice how this fib hasn't quite broken, but it does have the potential based on that momentum? Does anyone see it? Does everyone see it? Hopefully everyone sees it. Do you see how the market went right to the middle of the retracement zone and bounced right off the mid-band inside of the retracement zone? This is it, guys. This happens all the time. Let's go see if we can find another. Let's see if the pattern works even into a termination condition. Actually, small triggers are breaking through. Let's go see what it looked like. All we're doing is we're looking at entries, guys. Where's that circle? Man. Well, there was a pullback right to those areas, right in the retracement zone. Maybe not your best look, but they sure do like those areas somewhere between where the market is most likely to retrace. As we go back again. Potential to break, hasn't reached the fib, all the momentum. What's it look like? Right back to support, right inside of those large triggers. Notice that even with the small chart dance, it doesn't get below those large triggers. And guys, let me show you why we use that refinement process. That one bar that told us that it was time to look for an entry, that one bar, all of this happened inside of it. But the most important thing that happened inside of it was a pullback to an area inside of triggers. That's all we've talked about for an hour. So how do we get good at it? I'm glad you asked. How do I get good at this trade, Mark? How do I find this trade in a live market? Circling tails is cool, right? Maybe I'm developing a little recognition of the pattern. Holy shit. I mean, shoot, dang. Pardon my French. Guys, is that perfect or is that perfect? That just happened. 6 minutes ago in the S&P, the perfect high probability trend trade. Odds favorable, nothing in the way, right back to resistance inside of triggers. Either give me a Y or a hallelujah in the room, because guys, that's your pattern and it hasn't stopped yet. It's still going down. How do I catch that? Well, I gotta figure out some advantages, guys. I got to be able to identify strong triggers. Bob, you took it? I can't wait to see it. I have to be able to identify strong triggers. This is my first advantage. I have to be able to identify weak triggers so I know when not to trade. The same is true with terminations and clear path, guys. So the goal, my hope and prayer for everyone in this room is that you learn to look at your large chart first, that you learn to let the large chart lead the way. Identify momentum and path, guys. This is the core of everything that you're going to do with this software. And these two concepts teach you to see the next trades, teach you to see the patterns that create the bigger plan. So take the pictures, annotate on the chart, take the time to explain why. Why is it strong triggers? Why is it a termination condition? Create a correlation between what your brain sees and what your brain tells you that it means to you in terms of advantages. Learn how to speak out loud as you look at your charts. I want you to scare the hell out of your pets. I want your significant other in the other room to start getting excited when there's odds favorable momentum. Post these pictures in your spreadsheet. That's that basic rules section. And if you go through and you take the picture and you take the time to write smalls below the large, wide, in the direction of the trend, the space between means strong triggers, odds favorable momentum, rule number 1 met. Guys, you're never going to wonder if you have strength in a move. And if you do the same thing for weakness, you're never going to confuse the two. You might break the rule because we're human, but it won't be because you don't know what you're looking at. So, chart reading 101. This is one of the things that I'm going to put in your goodie basket. The next one is going to be the high probability trend trade checklist. This is the checklist that was designed for the brand new user. This optimizes your chances of success. This is the best of the best way to take a high probability trend trade. And it starts from a strong top or bottom, a no triggers through termination that reverses the market. It's not mandatory. You can still take a high probability trend trade without it, but anytime it happens right after a strong top or bottom, I want you to feel extra good about that trade. You have to define the momentum. Strong triggers, weak triggers, know the difference. So as you take those pictures, let this be your cheat guide. Is it a termination condition? Does it only have the potential or is it broken? Guys, if you know what you're up against, you know how to manage a trade. If you know what you're up against, you know if you have the advantages. So get in the habit of saying this out loud. This only has the potential to break. I might have to manage assertively. This is a clear path. It's going to take an act of God to get me out of this trade with all that momentum and a clear path. So then define your entry. Get in where the market is most likely to continue because great entries create manageable trades. Great entries reduce risk. Great entries maximize profit potential. Learn how to do these very simple concepts, guys. And then I'm going to give you a plan to follow as the brand new user. This is the KISS plan. And the KISS plan is a stepping stone in your learning journey. Jerry, 1967. But Mark, other people are taking more trades. Absolutely they are. They've learned how to read their indicators. BYU, the same is true. Miss Trina, absolutely the same. This isn't your get-rich trade. This is the one that teaches you to recognize your get-rich trade. Ron, Nichols on the way. This is designed to optimize your chances of success with the high probability trend trade as the new user. And then through simulation, study, feedback, and continuous practice, you're going to be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. When you're a chart reader, you're going to see things. And there's a couple guys in this room that are amazing examples of that. So there's two things you have to know before you sit down to trade and you're not on simulator. And man, this is so important. Before you're not on simulator, because when you're on simulator, guys, F it all up. Fudge it all up. Make every mistake and learn how to correct it. Learn how to avoid it. You need to know why you're going to enter a trade. And rules are nothing more than a description of a pattern that has been proven to win more than it loses. When I have odds favorable momentum, when my path is clear, when I get a pullback to an area inside of favorable large triggers, this is a trade. And this trade is nothing more than a pattern that has been proven, validated, verified. I trust it. I know that it wins more than it loses, guys. Nexgen's done that for you. Nexgen has already proven. That's why I teach it. You need to go back and prove it. You need to learn to trust it. And once you do, you'll never miss that entry. Never miss that entry. You don't have to know what happens next in the market. You know the pattern wins more than it loses. You lose a lot of butterflies in your stomach with that level of trust. And then you have to know why you'll exit. And exits are either taken at profit targets, predetermined, or key areas, whatever your plan says. Or when advantages go away, when the things that got you into the trade are no longer present. One of the biggest ones for the high probability trend trade, I'm going to go to the termination conditions section because I pulled this out of the initial. There is one termination condition on your small chart. I apologize for the scrolling. There is only one time when the small chart will tell you that rule number 2 isn't met. And this is going to be used for two things. The first one, if you see 3 divergences in the same location on your small chart, you have to say to yourself, I will not take that next long trade. I will not take that next short trade. 3 divergences in the same price range may terminate a trend. So that's the first way you'll use it when you're looking for entries. If you see it, kill the trade. The second way is if you take the perfect entry right at an area, right inside of favorable large triggers, your target's off in the distance, but 3 divergences print, you can use that as a change in the market before profits were reached that tells you to exit the trade because the market may push higher. That's the only thing on a small chart that's going to do that for you. Otherwise, we're holding for targets. So define your entry. Great entries create manageable trades. Great entries reduce risk. Great entries maximize profit potential. Experts in the field will tell you that successful mature traders manage their risk before they ever manage their profits. You're managing your risk through momentum, clear path, and precision entries. And then your palms are going to get sweaty. You're going to enter that market. You are going to feel nervous every time you see a tick go up or down. Every time you see a red number, you're going to want to move your stops. You're going to want to adjust your targets. Guys, if you allow your management to be every bit as mechanical as your entry as a brand new user, it's going to pay huge dividends long run because we're learning to trust. So the KISS management plan is based on 2 contracts, entering the market with 2 contracts. And it's designed to help you understand and trust stop placement as well as being focused on getting profits captured quickly. That just, I don't know, that sounds too official. Let's do this. Focus on getting paid. How's that? That's the goal of trading. You're going to know where to put your stops and you're going to try to get paid. That's the goal of every trade. You're going to create your own management plan, guys, once you can read indicators. It may be different stops, it may be different targets, but in the very beginning, keep it super mechanical and let it play out. Resist the urge to arbitrarily move your stops and targets. So, it's nothing but if then. If my entry is 2 ticks below resistance inside of triggers, high probability trend trade entry, then my initial stop is 4 to 5 ticks beyond the triggers. And there's nothing else for me to do. This is it. My 71.34 entry will have a 71.49 stop, $150 per contract. You have to be okay with this risk. If you're not, don't take the trade. But you will know your risk before you ever enter the trade. You'll know exactly where 4 to 5 ticks beyond the triggers are, and you can make the decision whether or not you're willing to risk that. You're on simulator, risk it. You're not going to lose anything. No one's going to repossess your simulator Ferrari. Take the trade, put the stops where the market shouldn't go. Your targets will be predetermined, guys, predefined, $100 and $200. So if you don't get stopped out, you're going to get a reversal bar in the direction of the trade, a confirmation bar that the market's doing everything that you wanted it to do. If a reversal bar prints in the direction of your trade, you'll redefine where the market should not go. It shouldn't go 2 ticks above it. They've already bounced. They've already started their way down. We're going to reduce risk. 2 ticks above the reversal bar. Your new stop is 71.37. Your entry didn't change, obviously. So you went from having $150 per contract. Now you're at $30 per contract risk on this trade. Feels good, right? Even if the market heads up from here, takes you out for $30, it's hard to cry about that. That's dinner for 2 at McDonald's. But if they don't take you out, guess what? They're going to your first target. You're getting paid. And if price reaches your target, one contract is automatically removed and those funds go into your account, guys. Success. Success is breeding confidence. Money in the bank. And you're going to move your stop to break even. You're going to take 100% of the risk off this trade. Not the best stop, but what it's doing is it's teaching you that when you have momentum and a clear path, the market's more likely to go down than up. You're learning to trust the large chart by having zero risk and funds in the account. It's either going to get you break even or it's going to go to your second target. Your second target is $200 away from your amazing entry. Your second target is going to pull you out of the market at $200 profit, which means that you just made $300. $300 with every advantage. $300 from a perfect entry. $300 from an early exit. And guys, if that's the best you can do every day, that's $75,000 a year. Let that sink in. $300, only $150 per contract. $75,000 a year. Add $100 into that, maybe from a different trade or bigger stops as you grow, you're in six figures. You don't need to be in every move. You don't need to take every trade. You don't have to fight direction. You don't have to trade into areas. You don't have to enter without momentum. Guys, you're going to see the potential for $400, $500, $600, $700, $800 within the first couple days of my classroom. You may not know how to capture it yet, but you're going to know that it's possible because you're going to see people posted in this room following these directions, following this plan, embracing this methodology, and doing it because they learned to read their charts. So I promised you guys everything you need to be successful. I'm going to drop my spreadsheet in there once again because there's no doubt in my mind everybody in this room is excited about the value that taking pictures puts for them. New users get more out of pictures than they do actual trades in the first week. There's no doubt in my mind. You guys have the ability to simulate. And more importantly, you have the ability to post in my room to show me everything that you're doing, discussing your chart read, making sure that it's accurate, discussing your entry, making sure that it's right, discussing your exit, making sure it makes sense. And every time you post in my room, it's just the two of us going through this. We're going to celebrate victories and we're going to correct anything that needs correcting. You guys now are going to have a plan, a written plan, a plan that defines entries and how to manage it. So the only thing missing, the only thing that you don't have is going to be the repetitions for it to be easy, the recognition. You don't have the experience. I can't give you that, but I've just given you everything that you need to build it. Ooh, my dog hates the Amazon person. So I just dropped a zip file in the room. Guys, zip files, you can download it and then you'll need to extract it. You'll have to extract the inner workings to a file, something like that. But inside of that zip file is Chart Reading 101, making you a chart reader better, faster, more effectively. Inside of that zip file is the high probability trend trade checklist. I didn't even show you, but the second page is just a checklist to print and put on your desk. Nobody's ever marked yes to all four of these, truthfully, and done worse than 70%. Just in case you were wondering. I'm going to give you the KISS plan in there. I can tell you that brand new users learning these very basic concepts following this plan have not only beaten the combines and the qualifications for prop firms, but found payouts within the first 30 days of their careers with Nexgen. I've seen it multiple times by keeping it simple. Inside of there is also the daily goals. Just reminding you that everything doesn't have to be a home run. I put in there as well the PowerPoint that I used to teach each and every day. For you guys that are like me, that less is more, I'm giving you this one. This one's called Trend Trade Simple, and this is everything that we just discussed. Everything that we just talked about in this first hour, condensed into 2 pages. Giving you the rules, where to find them, the indicators that we use, showing you momentum, termination conditions, what they look like when they break, reminding you patience, talking about the entry, going through everything, as well as how to study. All of that's in there. And then there's one more. This is my favorite. The pictures you can take. So this is good going into the second hour because the second and third hours are nothing but feedback. Nothing but feedback on the pictures you post. And you guys look like you're posting a lot. You're going to keep me busy. Remember, these pictures are unique to the trader, but there's education opportunities for everybody. So if you post in my room, there's always the possibility that I'll take your chart. And even if you don't need the lesson, I'll turn it into a lesson for the classroom. The pictures that you can take, guys, the pictures that I take every time I take a trade. I take a pre-trade. When I set my limit order, I take a picture. And I'm going to tell you, I go back and I study this picture to make sure that I didn't miss anything in my analysis, to make sure that I didn't accidentally break a rule, because sometimes I do. And if I did break a rule, I start to see the pattern of what rule appears to be escaping me or which one I choose to ignore. We all have a thing. Your thing will probably be termination conditions. Everyone's is. I take a picture during the trade. I've been known to take upwards of 6 or 7 pictures during a trade. I take a picture every time I move a stop, every time I take a profit. And guys, I'm not annotating these charts in the moment. I'm not, because I'm trading. I got to focus on my trading. But then I take a picture after the trade, from entry to exit. And this is where I'll go back and I'll write my rules on the chart and make sure that I had all those advantages. I'll talk about my entry. I'll talk about my exit and why I took that exit, why I held a little longer than I should have, why I didn't exit in a line, whatever. And this is going to help me build my management plan as well. But this is just kind of going back, and it's a synopsis. This is the one that goes into my spreadsheet. And then finally, I take pictures when there's no trade. If I feel like my rules aren't met, I'll take a picture instead of a trade. If I am bored, I'll take a picture instead of a trade. Guys, keeping yourself busy instead of just wishing that you were in the market is good. And then pictures 3 and 4, these are the ones that I want you to put in class. I want you to show me your chart read, your entry, all the way to your exit every time you post in this room. A lot of people love to show me their entries, and then when they lose the trade, they don't show me the rest of the trade. And guys, there's lessons from start to finish. Give me the opportunity to teach those lessons. And then the no trade. Guys, this one becomes brilliant to put in the room, because what happens is if you tell me that small chart terminations kept you out, we have a lesson on where to find terminations. And if you tell me that small chart momentum kept you out, we go back and redefine where momentum is found. And if you jump in early, if you get in late, if you tried to hold through a termination condition and gave it all back, every picture is an amazing lesson. So as we go into the second hour, guys, every chart posted, I'll go back to the 3 rules. Every chart posted, we will discuss momentum, we'll discuss path, we'll discuss entry. Don't be the trade police. Focus on the basics, brand new users. And remember, the squeaky wheel gets the grease. The people that post the most in this room get the absolute most out of this classroom. And it's y'all's amazing questions that make this classroom a better classroom. There's no doubt in my mind about that. So, are there any questions before we take our first break? Is there anything I can cover, talk about before? Do you need help to be able to take pictures? We can do that when I come back. Should we go stretch our legs, meet back here in 5 minutes, 4 minutes? Ron, have a great one, man. Have a great afternoon. All right, guys, I'm going to walk away for just a minute. When I come back, we'll do a little bit. The rules in the meeting? Sure. Jerry, did you see right there all you need? Download it. Because inside of that all you need is Chart Reading 101, Daily Goals, the PowerPoint that I used to teach, the High Probability Trend Trade Checklist, the KISS plan, the pictures you can take, and that Trend Trade Simple one, that's the one that's going to give you the rules, their meaning, how to identify them. And the cool thing is you could also go to, if you wanted to, the YouTube page for Nexgen, go to the live streams, and this is my classroom every day for the last 2 years, and the first hour is exactly the same every day. So if you just want to kind of reinforce those rules and take that very basic 101 lesson, Crank it up to 1.5 times speed. Watch that first hour over and over. Pause it at the lessons. And it's pretty cool. And then the second and third hours, that's where the feedback comes in. That's where you start to see how this educational process not only gives you the foundation, but we're committed 100% to giving you feedback on everything that you see and everything that you do and everything that you'll use. So you caught some of it. So Ron, he's about to leave. We'll go through his chart. Ron says when the large chart is screaming down and there's nothing in the way, he'll use that momentum to capture quick profits. And then when it changes direction and screams the other way, he'll use that momentum with nothing in the way to capture quick profits. So for you new users, this is called the chili dog trade. This is not a Nexgen trade. This is a Ron C trade. And it is based 100% on, you guessed it, momentum and path. Pretty cool, right? I told you, you could build a plan confident, capable, consistent through just the first two. So I'm going to go refill my water and high five my wife. When I come back, we'll go through and we'll take a look at everything. And guys, that's crude oil reminding you that 90% of your day is doing nothing. I'll be back in 5, guys. Go stretch your legs. And then, Jerry, was that what you needed? Let me ask real quick. I think I also should have given you this one from the user guide, the trading plan. Whoops. Let me give you that link as well. Oh, you're so welcome. I'm sorry. I'm a worrier. So if I think you guys need something, I have trouble walking away. I'll be back in about 4 or 5 minutes, guys. We are back for the second half of class. So for those of you that are newer with me, what do you think? It's a lot. It feels like a lot in the beginning. I know that it feels like a lot in the beginning. I have been at the beginning. I try to teach taking nothing for granted. Like you don't have any ideas. Let's take it slow. Let's focus on some basics, guys, and it's all going to click for you. So I'm going to start at the top of the room and I'm going to begin clicking on pictures. And from these pictures, we're going to see if we can't create a couple lessons. Whoops, that was yesterday, not today. I missed it. Wayne, you did something last night, so we'll start with Wayne's last night. And Wayne says, check it out, Mark. JTFI with momentum, followed by a heartburn. So I speak fluent Wayne now. What is Wayne saying? Wayne's saying, Mark, I want you to see that I've got the best momentum on 3 separate charts. I don't have anything in the way on 3 separate charts. And with this level of momentum and clear path, there's those magic words again, new user. I'll get in and I'll get out before that momentum wanes, before it subsides. And that was a quick 110 on 2 contracts. Guys, that is a $220 trade over the course of about a minute. Pretty cool, right? And then Wayne has found a pattern. And man, it's hard for me to get on with this pattern. But Wayne knows that the small chart fights. Wayne knows that retracements are a part of trading. And Wayne has done enough study to say a lot of times it happens at this white line on a market flow chart. New users, you don't have this chart. You don't need this chart yet. But Wayne says, you know what? I found a way to capitalize as the market goes back to that entry for the high probability trend trade because I've found a place where it happens more than it doesn't. And Wayne, absolutely awesome. Great trading. The first one is not a high probability trend trade, but it's based on his ability to read indicators. The second one is not a high probability trend trade, but it is based on his ability reading indicators. Have I mentioned that when you can read indicators, you'll begin to see more? All right, Miss Jen, you got caught in a fib update. A little bit. So guys, this is the NASDAQ, and the NASDAQ is a different animal. And Jen, I feel like this is my fault. So you've got all the momentum. You've got a strong bottom. The fib update got you, without a doubt. I see it. It'd been there for a little bit. For at least 3 bars worth. But I want you to see, your entry was the pullback to the area inside of favorable large triggers, Jen. Do you see how those small triggers had already behaved as resistance? And I don't know if you got in on the way down or the way up. But they definitely were not a full bar away. Does that make sense? So guys, one of the things about the NASDAQ is if those small triggers are not a full bar away, they're very likely to behave as resistance. They're very likely to just run you right over. So you had a buy order at the area. Okay. But I feel like I've nagged you so much about those triggers being a full bar away because there's been a couple opportunities where you could have gotten at the area that you probably subconsciously said, F Mark, I'm going to get in at the area this time. But those triggers were too close. And they did exactly what we would expect them to do. Does that make sense? So this is the one where an entry on the correct side of the triggers pays dividend. I speak fluent, Jen. I've been married to a different version for a long time. This is the I'm going to take it at the area because I feel like I've missed it at the area when the conditions were right trade. But it's still, it's a great look. The entry is accurate, but these small triggers on the NASDAQ, that was your demise. So the NASDAQ is different than crude oil, guys. The NASDAQ is different than the S&P. The NASDAQ small chart, its entry chart, is as big as the large chart on your other markets. The large chart is 3 times larger than the typical large chart. So these trigger lines, these fast moving averages carry a lot more weight on the small chart on the NASDAQ. And the biggest way to be successful, and Jen, this isn't for you, you know this lesson. The easiest way to be successful with NASDAQ trend trades is to never fight these triggers, to wait for them to get to the other side. So I love everything about the trade except the fight. NASCrack. It seems like it, doesn't it? That's what the methamphetamine kids trade. It seems slow to them. 2, 3, 4. All right, Wayne. And guys, I love this. You notice Wayne posted 4 pictures in the room right in a row and said, you know what, Mark, this classroom is designed for feedback. Let's get some. I love it. Never been mad at Wayne for multiple postings. I'll never get mad at you for multiple postings. Both trades were odds favorable momentum, 50-50, meaning the small triggers are through, but the large triggers are not, and they're coming from a termination that reversed the market. So we've kind of covered all of it. Where's it coming from? What's my advantage regarding momentum? Is the path clear? His first entry from the top of the retracement zone, right at the area, easy money on the way up. His second trade, there's a big difference. There's a big difference between these 2 entries, guys. And I'm going to talk about what they are before I look at his next trade. When you have the potential to break, I'm going to take the picture. And guys, this is a lesson for everybody. Just because it's your chart doesn't mean that I'm singling you out. Remember that. So if it's only 50-50, if it's only the potential to break, can you guys give me a why if you understand that the path isn't clear? You have to say to yourself, my path isn't clear. I might have to manage aggressively. Does that make sense, everybody? This is important. So the path isn't clear. Here, I'll do this. On his first entry, there was no divergence on the pullback. There was no loss of momentum at the pullback, which means momentum is still intact 100%. On his second entry, divergence printed. Divergence is a loss of momentum. It is a visual loss of momentum. So on 50-50 trades, how do we feel about the advantages going into this trade? This is a best of the best scenario. On the KISS plan for that 50-50 medium probability trade, it says absolutely no divergence on the trade. Wayne's pretty smart. Wayne knows that because it's from a strong bottom, he's willing to take a shot. Brand new users, I want you to get it in your head. Divergence kills 50-50 trades. It's the biggest killer of 50-50 trades. There's a second picture. He's in. His risk is below the bottom of the bar. And they came and got him. They came and got him. A second divergence printed. So if 1 is bad, 2 is horrible. If 2 is horrible, 3 is detrimental. So guys, one of the things that I'm going to point out in this trade, sometimes it's a good looking trade. I agree 100% with the trade. But I think that management could have been more accurate. I told you guys, I'll give you everything that I have. If 1 divergence is detrimental, and 2 divergences is even worse, when this divergence is true, right there, it's a 3 or 4 tick loser. That's it. The market's telling you it's going lower. The market is telling you 100%, we're probably going to push down. There's a loss of momentum. We don't want to go up. The path isn't clear. Guys, you can take smaller losers. And I want to show you how important that is long term. A $30 difference over 252 trading days a year is a $7,500 difference in equity. It's a $7,500 difference. Being willing to exit a trade when the market tells you it's not going to work, guys, take your hickey. You're amazing. You're good at this. You're going to find the next trade. You're going to find the winners. But management, when you know that it's not perfect, look for changes telling you it's not going to work. Manage aggressively. Wayne, does that make sense? You can't sad face that. They told you they were coming for you. You're welcome. I love the entry, dude. And they just told you it wasn't going to work. That's all it was. And Wayne says, I'm not going to cry about it, because check it out. I'll get odds favorable momentum 50-50 again. I'll get no divergence. I'll get a perfect entry, and I'll make it all back. Absolutely beautiful. And one of the other things that I want to mention is you notice that Wayne's taking 110 per contract. His average trade's about $200. And you're winning what, Wayne? 70 to 80% of your trades with your plan? That's not so bad. That's not so bad, guys. Base hits pay bills. Small wins add up. Your account doesn't know how that $670 got there. Your account doesn't know if it was one trade or four trades. It just knows that it's positive. Great trading on that, Wayne. Only one opportunity in there that I could find that might have been a little helpful. All right, Bob, we just doing some chart reading? So I'm going to go through every one of Bob's chart reads here. And all he's doing is identifying things. So we're going to start on the left. Strong top, pivot from divergence. I like it, Wayne. Let me know how I can help. But I think on 50-50s, that second divergence is a big indication. All right. So, Bob, we're going to start... we're going to start with a definition of a strong top or bottom, because you've got a couple on here, okay? And this is for everybody, not just for Bob. A strong top or bottom, ladies and gentlemen, is a termination condition that reverses the market. It's a no triggers through termination condition that reverses the market. So when I talk about triggers being through, we used this analogy a couple weeks ago. I want to do it again. When I get to this line and my small triggers are screaming up to it, this is the front of my car. This line is the back of my car. And this is the brick wall that I'm trying to drive my car through. So in order to say to myself, small triggers broke through, both lines have to get above the line. Or to say that they didn't get through. Even if one line gets through, it's okay. The back of my car is still trailing. So when we use the idea that it's a no triggers through termination, force both lines of the small through. That's what creates that weak top, weak bottom. And then Bob says, check it out. Pivot from divergence. And this is a very, very common mistake, and it's actually so common that I've got a little thing. So I'm going to drop this in there, guys. There's a little snippet on strong tops and bottoms for the new user. And I'm going to drop this one in there as well. And this is the difference between a pivot and a pivot stop out. And what it does is it talks about that divergence that Bob called a strong top. So one of the most misunderstood concepts with termination conditions is when you have a pivot with a loss of momentum. So we'll define pivot first. A pivot is anytime the market changes direction. Goes up to down, down to up. It's just a pivot, that's it. Not a termination, doesn't come from a line. If there is a loss of momentum at that pivot, if the sellers stole momentum from the buyers, if the buyers stole momentum from the sellers, you'll see that pink line. You'll see that blue line. So here is the key to understanding that a pivot with a loss of momentum is not a termination condition. So Bob and everyone in the room, this pink line doesn't print until the middle of the third bar. That's when the calculation is done. This blue line doesn't print until the third bar up. So what does that mean? And this is where language pays dividends. Price and loss of momentum creates the divergence line. Price did not reach that line, so it can't be a termination because of the basic termination identification language. Do you guys remember when we talked about defining a termination condition? It was two parts. First, price reached an area, and then the triggers stayed below. So what happens is that this is never a termination condition. This is simply a loss of momentum. Does that make sense, everybody? Because price didn't reach the area, price creates the area. Let's go back to your picture. See how the triggers got through the actual lines? So we're going to call this a weak top. The triggers got through. And that's so common. And then let me go to the next picture. That divergence line becomes a termination when price reaches it. That divergence line becomes a termination when price reaches it, and then the reversal. I love this lesson because this is a really common lesson, and it took me a little bit to get it. So that's a weak top, and then that would be a weak bottom as well. And you saw that one, small triggers through the fib, you called it weak, perfect. And then we get that strong top. Then we get that line reached, all the triggers below, and then coming down, and then that becomes a strong bottom. None of the triggers get through. So annotation is really good on this chart so far, Bob. And then you called this a clear path. And there's a lot of things that I see. I see price hitting one-to-ones. I see large triggers below 7 fibs. I'm not sure how you defined this as a clear path. Do you see how it isn't? Clear path to the one-to-ones. Okay. So check it out. You ready? We're going to go back to language again. When price reached this fib, Bob, it was a termination condition because the triggers are below. When price reached the next fib, it was a termination. When price reached the next fib, these are all terminations. Small triggers get above these three areas. Large triggers are below. So now these have the potential to break. Whoops. But they're not broken yet. Does that make sense? Do you see how the large triggers never got above any of these areas? Those areas never broke. You never had a clear path to those one-to-ones. What you did get is you threw those one-to-ones into the mix as potential to break. But you never got a clear path to the upside. Does that make sense, everybody? Remember we said sometimes your path won't be clear because the areas are stacked? This is one of those examples. Good stuff. Bob, I'm telling you, there are more lessons in posting pictures like this than there are taking a trade. I believe that 100%. And then it turns, and you have odds favorable momentum. Smalls and large get below all of those areas that never broke, and you better believe you had a clear path. Great job. 2 amazing lessons in this picture, Bob. I appreciate that you had posted in the room for everybody, and I hope that was helpful for you. Not one trade on this chart, guys, just a whole bunch of chart reading. And my promise to you was that I would make sure you're reading your indicators accurately so that you could identify advantages. Really well done, Bob. Thank you for that post. All right, Pete said this one was from yesterday, this one was from this morning. So let's see what Pete's up to. Pete's one of my guys that's been doing this a while. Doesn't always trade, high probability. Weak trigger, weak top because the smalls get through, triggers rolled, down and separated, 50-50. There's the 50-50 trend trade. And Pete says, check it out, with that momentum and the potential to break, I'll trade a little snap back to the fib. This is a momentum trade. This is in the Nexgen rules. He gets out at the fib because the fib could have been problematic. He identified trouble. It's not broken yet. But he said, with this level of momentum, I'll force the market to give me something to get me out of this one. And if they don't, I'm going to get out a couple ticks above that fib. Pete, this is beautiful. Instead of trading into the fib, you let it break and you trade from the fib. Get out at the next fib and then hold that momentum. I mean, rock star. And then the same look going the other way. Everything says up, the momentum is strong, no divergence, pull back to support in the retracement zone. It's just a 50-50 trade without divergence, and sure enough, it goes right up to trouble where Pete gets paid. Awesome. You say somewhat of a risky entry as mid-band was between large triggers with divergence, but big momentum on the large chart said take a shot. So, Pete, thank you for putting that. You guys ready for a lesson? You're going to love this. Or you're going to hate it. I don't know. I won't tell you how to feel. Once the pullback started, the market had the potential to retrace anywhere between this area and that area. Triggers define the retracement. You guys remember that lesson from entries? What creates a bounce? Oh, there was divergence? Oh, okay, Pete. So yeah, I agree. Maybe a little more risky. But what creates the bounce? Areas inside of triggers. And then Pete, with the divergence, that loss of momentum, it stands to reason that maybe it would push a little lower. But here's the one question. Was your stop where the market shouldn't go? Did you put your stop where the market shouldn't go? There you go. So it's acceptable risk to you. You knew where your stop had to go. You knew where you were taking the entry. And all Pete did is he said, with the advantages that I see, I'm willing to risk this much money that all of that momentum will carry the market back up. You guys see how he broke a rule in your eyes? But what he really did is he weighed out the advantages and the disadvantages and chose to take the trade based on more advantages. I call that the bar fight scenario. If you've got a drunken rugby team behind you, you're not too scared of taking a swing on the chess captain. Great trading, Pete. I won't ever beat you guys up for breaking rules. I'll look for the big picture. I'll make sure you understand where risk went. It's not my job to tell you guys how to trade. It's my job to just talk about the advantages that you see. All right, let me see which way you were headed. You say no odds favorable, no clear path. All triggers down on small and market flow chart. Almost. So what is Wayne saying here? Wayne says, Mark, I'm going to take my large chart read. And you did have momentum up, Wayne. But you're not coming from a strong bottom. You don't have a clear path. And your small charts are showing you change that you can't see on the large chart. Your small chart is saying, guess what? This mid-band is likely to hold. This chart slowed down and gave you momentum down. This chart slowed and gave you momentum down. And Wayne says, check it out. Large chart still says up. So this is when I said, guys, don't do it like everybody. Trina, don't even look at this chart. Just kidding. Wayne's a great chart reader. He said, small chart will show me change. Triggers will roll. I'll get momentum the other direction. Triggers will roll. I'll get momentum the other direction. This area has less chance of breaking because of the bad bottom, and he found a way to capitalize and make quick profits. So large chart looks like he's fighting everything. Small charts show that he knows how to understand the change on the small charts that you can't see on the large charts. It's a great trade. It's a little more aggressive. Wayne likes to be aggressive. But it's not aggressive if you've proven the pattern wins more than it loses. It just looks that way to the outsider. Who was this? I clicked on it and I didn't even bother to look and see who it was. Oh, this is Wayne again. Need more patience. Played momentum trade wrong. So, same thing. Termination condition. I love it. Everything starts with the termination. And then, Wayne, all you did is you took the white bar trade. I don't think you played it wrong at all. You took this trade perfect, as John Novak taught it. 100%. It just turned into an HVA trade. Did you guys know that losing a trade isn't a failure? That losing a trade isn't a negative? That losing a trade that fits the rules is a positive because it means that you took that trade. Acceptable losses. Wayne, acceptable losses, 100%. You took the white bar trade. The white bar trade turned into the momentum trade. The only thing you did wrong here is you didn't take the HVA trade after. Maybe because you were upset about losing that one. And it came so close to your target. I made a picture, maybe it was this week, maybe it was last week, I don't remember what. Guys, there are so many trades that you can take with this software. There's so many ways to make money with this software. Let me see if I can find that picture. There it is right there. Termination condition holds. That's the key to 90% of them. Wayne, you took the first trade, the white bar trade. It didn't work. It turned into the second trade, which was the HVA trade. You chose not to take it. After the HVA trade, we typically see that Nexgen momentum trade. That's number 3. And then it turns into the best of the best, guys. So for all you new users, I'm asking you to wait for the 4th possible trade because it has the highest chance of success. And then I threw in Ron's trade just because it's a brilliant trade, but that typically happens maybe after. So Wayne took the first trade, didn't work, had opportunity for the second, chose not to take it. It probably turned into a momentum trade, and if it kept going up, it probably turned into a trend trade. So just because you're not catching all of them yet, guys, it's coming. It's coming. You will get to the point to where all of these are easily recognizable to you. So Wayne, you didn't take a momentum trade. He's the mechanical guy, Trina. It took me a little bit to figure him out. Wayne and I have the similarities. We both played on motorcycles and like things that go fast in mechanics. So I know he thinks like a mechanic. And he knows every now and then the engine's going to fail. So Wayne, just know that this wasn't a momentum trade. It was the white bar trade. And all a white bar trade is, maybe this will be helpful, is you're anticipating this HVA line and hoping that they never come test it. Does that make sense? This anticipates the HVA, and this trade says, I hope they don't make it back to it. But if they do, it's a good one. I think you did it perfect. You mislabeled it as a momentum trade when it's a white bar trade, but it's gorgeous. Gorgeous, Wayne. All right, what's next? I love it when you guys post a lot. All right, Miss Jen. Strong top, no triggers through termination that reverses the market. Beautiful annotation. Odds favorable momentum, separation between the small and large. Beautiful annotation. Price clears, trouble. This is one of those chili dog trades. Jen says, you know what? I don't want to get up on the way up. That's the small crowd fighting. I want to get in on the way down. And she does beautifully. And out at trouble. Protects herself and rides it down to the next level of trouble. Jen, great trade. NASDAQ is not easy to take these trades on. You did it absolutely perfect. Absolutely perfect. I really stink at seeing whose trades I'm looking at. Hold on. That was Miss Jen. Wayne, is this you? This is Wayne. Yeah, when it's screaming, it's easier. Momentum and path. So trigger more than a full bar away. All right, so here we go. Little misunderstanding of rules. And this is why it's so important to post your pictures with what your chart read is. So Wayne, you're saying with this line above that reversal bar marker, the triggers are a full bar away. I disagree, respectfully. Because two lines make the large triggers, you've already reached your large triggers. 100%. So what Wayne is talking about is what we call the gap theory. And I'm going to show you a great visual of it for my newer users. Yeah, but there is, I know the software well enough to know that that wasn't even close to the gap theory. So the gap theory states that if price pulls away from the synthetic triggers, that's those large triggers on your large chart, too far and too fast, and they reach an area, fib, midband, whatever, price is likely to snap back and close the gap to those large triggers. Guys, this is the same idea that we use to identify entries because price tends to return to the large triggers. So what that looks like, and this is what it has to look like on your large chart, is price comes back, reaches that midband. This is when your midband is a termination condition. When you're using that reversal bar marker, both lines of the large triggers have to be below it. Or conversely, both lines of the large triggers have to be above it. Little aha moment. I'm telling you, guys, even the greats have aha moments in this room. And all it says is that price is likely to close the gap back to that trigger. That's all it is. This is called the gap theory. And it's pretty awesome. And it typically looks like that, right? So if they're above or below the reversal bar marker, both lines, Wayne, that's when the gap theory comes into play. What you had here was a pullback to an area inside of triggers with the potential to break. The first one was perfect, 50-50 trade. The second one had divergence, which is a little less enticing. And because it's from a bad top, because it's not a strong top, the 50-50 is more likely to fail, especially with divergence. And the midband is more likely to create an ugly bounce because after that strong trending market up, they might be inclined to go back up to the next key area. Does that make sense? Great lesson there, dude. Thank you. Dude, that's probably not the most professional. Sorry, guys. I'm an HR nightmare, but I'm good at reading indicators. See, I think there's a time to play at the midband. I think there's a time to ignore it, Wayne. And so let me show you the time where I don't give two craps about a midband. If I have a strong top and I have odds favorable momentum and I have no divergence, I'll take that 50-50 all day. Couldn't care less about it. If this is not a strong top, if divergence prints, I'll wait and see what the bounce is. That's my take on it. No, strong triggers, strong top. Strong triggers, best momentum ever from a key area that reversed the market. Let's go see if we can find a real world. Strong bottom, strong triggers. They blew right through that midband like it didn't exist. Weak top, gap theory, never even made it. That's consolidation. Weak bottom, right back to it. Sure enough, it pushes down, closes the gap. Strong top, strong triggers, not a full bar away, blows right through it. Do you see the pattern, Wayne? I know you're a patterns guy. Weak top, right to it, bar away, respect it. I love it. Good lesson, man. And look at that nonsense. Woo. Crude oil is jockeying for position. Good picture. Guys, I'm telling you, I don't care how advanced you are, you'll learn something new every day if you participate in my class. Nexgen. Strong trending market down, Chili dog tard. You can't say tard anymore. They took that from us. Don't normally do this on the NASDAQ, but very fast momentum down. Everything is screaming down. Everything is screaming down. And Jen says, let's see if we can't pull a few hundred out of this market. Momentum and path. Momentum and path. Good stuff. Oil is sideways, Pete. And just so, Trina, just so you know, BYU, if you've never posted in my room, start with a picture of your dog. I will love you forever. I want to see your puppies. I feel like I've watched this one grow up. Pete, don't ever stop posting that one. You guys have fun at the dog park. Great job, Jen. 2 for 2 on that momentum. All right, we looked at Ron's. Miss Jen again. Now it's strong trending up. This was the best entry. The area inside, they never even turned, Jen. That's rare that you get that on the NASDAQ, right? So you get in pretty late. That's okay with all the advantages. Out at trouble and couldn't care less about what happens next. And I think this is one of the greatest things that you could ever see in a chart posted in this room is understanding that this line could stop the market. That line could end all of the forward progress. That line could create a giant reversal. And Jen says, I get it, it might break. Areas break all the time, but I'm going to get paid at trouble and I'll wait for the next trade. And I'll wait for the next trade. And I'll wait for the next trade. And Jen, you have had 0 problems finding the next trade. Great job today. Nice reset. Hey, John, welcome. So what Jen is doing here is what we teach in the first hour every hour. Learning to recognize when your large chart is giving you the advantages you need to look for a trade. So here she had momentum. Her area had the potential to break because of this momentum. And she recognized areas inside of her triggers on a small chart. And this defines your entry point. This shows you exactly where the market is most likely to bounce and continue with momentum. Jen got in a little bit late on this one. NASDAQ moves super fast, and it's hard to trade as a new user. But what she did, and let me take a picture of this, Junior, because this is one of the greatest things about what we do. I'll look at that in 1 second, Jen. Is everyone... Why is it not coming up? There we go. Each of these lines has the potential to stop the market. You know about them long before you get to them. So what it does for you guys is, one, is it gives you an awesome place to enter. When everything is going up, a little push down typically stops at an area. And it gives you an awesome place for targets because you know that that could stop the market. And what the intelligent traders do, what the confident traders do, is they trade from this line to that line, and then they sit on their hands and do nothing. And if that line clears, they'll look for the next opportunity. In understanding, and this is the advantage of Nexgen, you know exactly where these areas are that could stop the market. If you go back to her other one, she let the area break. With all that momentum, she found a way to capitalize. She let the area break. With all that momentum, she found a way to capitalize. So the lesson in this is trading from a line to a line. When the large chart says, typically yields the biggest results. I hope that made sense. And welcome to the classroom. It's great to have you here. So every morning in my first hour, Junior, we talk about 3 advantages, and we really keep it simple. We talk about being able to identify momentum, and we use the trigger lines for that. And we talk about whether or not something's in the way, and then how to get in when you have these 2. And it's called a high probability trend trade. I'm going to drop a little, it's a Word document. Do me a favor, go through that from top to bottom, click on the pictures after class. And it'll create a lot of clarity of what we talk about every day in this room, taking 3 very simple advantages and learning how to capitalize them. And all these rules are, it's a description of a pattern that has been proven to win more than it loses. And this is the foundation for new users. And then once you get comfortable with these concepts, and I'm here 15 hours every week to give you feedback as you get comfortable, you start to find even more opportunities in the market based on the advantages that you see. So that's what we do every day in here. And Miss Jen is putting on an absolute clinic for everybody. And then I want to share this picture too, because I show this at the beginning of class, Junior. Your first couple days in here feel a lot like this. As you learn the terminology, as you start to see these things for the first time, it feels like drinking from a fire hose, guys. And I know that it does. And I'll never pretend that it doesn't. When I first started with the software, let me talk a little crap about my brother real quick. For those of you that don't know, my brother is John Novak. My brother wrote this software. He created this algorithm. And when he was teaching me this software, he had one phrase that just haunted me. He used to say, it's obvious. Well, Mark, it's obvious that this is what the momentum is. And Mark, it's obvious that you shouldn't trade into this line. And Mark, it's obvious that this is where your entry is. And guys, I'm telling you right now, this was me. Nothing was obvious. Nothing was obvious. Momentum wasn't obvious. Terminations weren't obvious. Patterns weren't obvious. And frankly, it pissed me off that he treated me like they were. But the one thing that he did for me, and he skipped this step at first, he said, this is how it becomes obvious. And he was right. Once I could identify these advantages, once I learned these very simple rules, once I started taking pictures and asking for help, he was absolutely right. It is obvious. It can be obvious, but it won't be in the beginning. So I've taken the most simple approach I know how to take to get you guys to obvious sooner than later. And there's a very clear path for it. So keep it simple. Simplicity is the path to it being obvious, without a doubt. All right, Josh. And guys, if you posted earlier, thank you for your patience. I know you're eager to get your feedback, and I always go through these in order. So thank you if you've been patient, if you're waiting. Josh, I know it's been a little bit since you posted this. Sitting on the edge. You'll pay for the whole seat. You'll only need the edge. Sunday, Sunday, Sunday. All right, did Josh have momentum? Hell yeah, he had momentum. Did he have a clear path? Yeah, both triggers got above those areas. Did he get a pullback to an area inside of triggers? You better believe he did. Trusted the rules and management. So $300 trade? Easy money, right, Josh? With momentum and path, you defined your entry and then you trusted your management. Great job, dude. 15-second trade. HR is going to kill me. That's what we call the high school sex trade. It is over before it even starts. But you still leave kind of happy. Sorry. This is why we don't have an HR department. I would not be here tomorrow, guys. But that's it. When it's right, it's perfect and it happens fast. And Josh, you nailed it. And I am freaking ecstatic that you held your position and trusted your management plan. So Junior, OFM, Josh just said it. It's shorthand for odds favorable momentum. And odds favorable momentum, when you look at that little document that I gave you, it'll make more sense. But we call it that. So when you have strong trigger lines, this is rule number 1, Junior. Anytime I have strong trigger lines, all it is it's this gap between your small and your large triggers. And that thing that I gave you describes the small and the large, so you know the difference. But anytime you have space between the two, the odds are favorable for the market to continue up when everything is green, or the odds are favorable for the market to continue down when everything is red. So in this room, people will annotate it OFM. And then one of the other annotations that you'll see in regards to momentum is when that space goes away, when that gap closes, these are what we call weak triggers. So this is your rule met, this is your rule not met. Here the odds are favorable for the market to continue down. Here we use the phrase, anything can happen because it's weak. You might get a bounce, areas might hold, there may be a retracement that takes you out of a position. So a lot of times you'll also see it annotated ACH. So if you go back to like a big snippet of the day, odds favorable, and it pushes down to that anything can happen, and check it out, there's a reversal. And then odds favorable, that's where a lot of these guys are finding entries. And then when it becomes anything can happen again, they just stop looking and they wait for it to reverse, or they wait for that momentum to come back. So that's one of the key lessons that we get first thing every morning in that first hour of class. And you'll see that same description on the Trend Trade Simple that I gave you. And if you want just to have a little head start for tomorrow, go to the Nexgen YouTube page. And all of these videos that look exactly the same are me teaching this room. And you'll find, Junior, that I say the exact same thing for the first hour every day. I talk about momentum, path, and entry for an hour every morning. Go back and watch that first hour. And then when you come in tomorrow, you'll have a little bit of a head start. You'll kind of know what we're looking at. You'll know what the indicators are. And you'll start going through the process of being able to identify so that you can use them. All right, so the heartburn trade. Everything says up, and Wayne uses that little outer band, and that one didn't work, right? No harm done, out break even. And then it hits the termination condition. So Junior, you'll learn about these as well. When price reaches one of these lines and those trigger lines stay below, that line's likely to stop the market. Wayne knows it. So Wayne takes a second shot. And that's the one that works. And let me read it. Entered on the way down from the outer band. Came within a tick of the target almost instantly. Couldn't move stop to even before money went back up. It happens. Price came back to 75%. Target went even with money. Rules still met for entry. 3 ticks above entry price. Kept you in. And you were able to make money. Nicely done. I think there's a point, Wayne, where those tight stops are going to bite you in the ass a little bit sometimes, every now and then. But it looks like you got a pretty good idea on them, because if it doesn't just go to it on this trade, it's probably not going. So I like that you get in and protect yourself quick. Notice the difference between the one where it almost hit the termination and it actually hit the termination. Huge difference. They knew where they were going. You tried to sneak in a little quick just in case. Didn't work. But once they got there, it was pretty easy for you to make the money back down. Nice trading, dude. You got to take a hickey every now and then, guys. You're going to lose a trade every now and then. Make sure you're losing the one where your rules are met. That is one of the greatest lessons I could ever give. If I'm going to take a loss, I don't freak out about it if I look at my chart and my rules are met. If I had odds favorable momentum, if my path was clear, guys, I'll take that loss all day. There's a termination that reversed the market. There's odds favorable momentum. Wayne, is that mid-band a concern? What do you think, brother? Triggers are not a full bar away. Coming from a strong bottom. Best momentum ever. Couldn't care less about that mid-band in this case. That's a great example of when it doesn't faze me. If I get a pullback to that area in the retracement zone, I want it. The first opportunity is a momentum style trade off the one-to-ones. If this momentum style trade fails, the trend trade is the next likely. And guys, at this point, it's not even a momentum style trade. It's just the highest point of support inside of favorable large triggers because of the momentum, because of the path, because of where it's coming from. Now we're just hoping they come and get us. 75 of the target, going even money is what you've been doing on less than perfect. So you identify that it's not the best of the best, and you manage assertively. Boy, they tapped us, but they didn't fill us. That's kind of uncool. If I get into this particular trade, guys, if they fill me, my stop has to go all the way down here. Are you guys comfortable with that amount of risk? Because it could go all the way down to the bottom of those triggers. It looks like they're going to try and make their way up to that target first. So we tried, just didn't get us. All right, guys. I'm going to take 2 or 3 minutes and then I'll be back. And we're going to get into the last bit of class. So if you're brand new, it's great to see the new people in here, Cav. And you're right. Keep posting charts. Ask questions until Mark says enough. Have I ever told you enough, Cav? I hope not. I hope I've never shut anybody down in here. Hey, Josh, have a great one, man. Great trade today, dude. You big virtual high five coming through. I'd give you a virtual hug, but I don't want to make it weird. Just kidding. You posted more? Did I miss one? I only saw the one from you. Oh no, there's one. I missed one. Oh, guys, don't let me get away with that. I'm going to do it right now, Josh. Odds favorable momentum? Yes. Clear path? Yes. Pull back to area inside of triggers? Yes. Money, money. Took a lap. It ran down for another 20 points. Penalty box. You know, there's a lot of products that'll keep that from drying up. Get the sand out of it, man. Didn't let it go. Large chart said it was going. Didn't make it. I don't know if you heard that or not. You'll catch it on YouTube. Beautiful trade. All right. Great first target. Absolutely no reason to exit. So you trusted one, didn't trust the other, which means you are 50% of the way there, Josh. This is a beautiful trade as well, though. And look at that entry, like a sniper. Rock star. Sorry I missed that one, man. If you ever notice I skip one, just tell me. I'll go back to it, I promise. Have a great afternoon. I'll see you tomorrow morning, 9 a.m. Guys, I'm going to go run a lap. I'll be back in just a second. Stretch your legs. Last half of the class is all you guys. Tell me what we're going to talk about. Back in a minute. As I am back. Wayne, I did not post a penalty box sheet. I most certainly will. And Steve Diego, you are damn right I didn't go and look at your picture because it's going to be 75 and sunny there. Jerk. All right, not really. I just missed it, man. I apologize for that. Let's take a look at it. I'm just jealous. John and I were talking the other day. John's got to get his spine fixed. But when he's fixed, we're going to come out and do a Torrey Pines weekend. So when we do, first beer's on you for picking on me. All right, so let's see. This is S&P. I love it when you guys start with this. Where is the market coming from? It tells you a lot, doesn't it? If the market is coming from a strong top, what does that say to you? It says, wow, moves the other direction are more likely to happen. Wayne, did you notice weak bottom? Sure enough, mid-band areas, and it continues down. One of the reasons I don't mess with these areas, don't even look for 50-50s if it's not from a strong bottom. Now it's a strong top. They smash right through the divergence low. Steve lets it get below it, takes the momentum style trade, and it gives him a little retracement. And Steve says, man, but with this look from a strong top, what's it going to do? It's going to bounce and go down. And it did. Easy 275. Nice job, Steve. I like it. Momentum and path, ladies and gentlemen. It's amazing what you can accomplish with momentum and path. All right, you guys ready for the best lesson you're ever going to get as a day trader? I'm going to annotate this chart because I'm brand new. And I took an entry right here at the area inside of triggers, and I got stopped out right there, 4 to 5 ticks below. And I'm mad, guys. And I'm mad, and I'm like, this is crap. I did everything right, and I lost, and I'm down money, and I'm upset, and Mark Novak's a snake oil salesman. I'm going to post this in the room, and that's a strong bottom. It's a no triggers through termination. And I had odds favorable momentum, and that's amazing. And I had a clear path, and that's incredible. And I had an area inside of triggers. And then just because Mark needs to know I'm upset, stop me out. What did I do wrong? Have you guys ever done that? I just took a loser. What did I do wrong, guys? Was it these one-to-ones that created a problem? What do you think? Was it that the triggers turned against me? Was it one divergence? What went wrong on this trade, guys? What was the mistake made? What do you guys think? Does anyone have a guess? There was no mistake. Thank you, Wayne. There was no mistake. I traded the perfect trade. I had momentum, clear path, and entry. Does anyone remember? Boom, there it is, Bob. 20 to 30% loser. This is what we call a cost of doing business. Guys, I just paid rent. Anything that wins 70 to 80% of the time must lose 20 to 30%. It's math. I'm not even good at math, and I know that that's true. And this is okay. And you may modify it, right? Wayne's got a modifier in there that he likes. But what happens is that if you take this trade and then you bottle it up and you keep it inside and you let it stew and you're so pissed off, you're going to make bad decisions, guys. Your emotions are going to take over and you're going to revenge trade and you're going to go long and lose and you're going to say, well, F it, I'll just go short, and then you'll lose. And you're like, oh, I'm going to go short again, and then you lose. Well, I'll show them, I'll go long. And you get on this emotional roller coaster. But if you look at it and you say, you know what? I had momentum and my path was clear and my entry is great. This is normal, guys. This is a normal part of a positive equity curve. And if you're not sure, you drop it in the room and I'll reassure you, you did it beautifully. If you took this loser, congratulations. You took the trade that wins more than it loses. It just didn't this time. So I wanted to go through that because that's such a big part of what we do. Learning to accept a loss. Learning to be okay with a loss, but learning to insist that they're the correct losses. There we go. There's Mark in the pulpit, right? It happens sometimes. So Wayne said, did you put the penalty box? I love this. This is one of my favorite images. So there's a gentleman. You guys that spend any time over in the traders chat room may recognize the name Siva. He's not active right now because he is such a disciplined trader that he trades for 9 months every year, and for 3 months he goes back to India and hangs out with family. He takes a 90-day vacation every year where he doesn't trade because he trades well for the other 9 months. But when he started with Nexgen about 20 years ago, one of the things that John Novak did back then, exactly like I do today, is we harp on you about having the rules met. Have the rules met. Have an advantage. Make sure that you have an edge. Focus on the process. And Siva said, well, if rules are my lifeline, there should be a penalty aside from losing for not following them, because I want to learn to follow my rules. So he created the penalty box rules. I don't know, maybe he's into hockey, I'm not sure. So he ordered them in how much they would affect his overall day, right? So the first one is missing a good entry. Not because you were pooping or getting coffee, but because you talked yourself out of a good entry, because the rules were met and you let your emotions dictate your entry. And he says, if I do this, I'm going to stand up and I'm going to walk away from the desk for a minute. Not I'm going to sit at the desk and convince myself I'll not trade for a minute. He would physically remove himself for a minute. If he entered the market late, if his rules were met and his entry was supposed to be at the fib and he waited for 2 points later because he didn't trust the entry, that was 2-minute walk away. Exiting for no reason. Getting out just because you didn't want to give it back. That's a 3-minute penalty, guys. Those little bits. Josh mentioned $60 that he left on the table because he made an emotional exit. Let's do that calculator trick again. What's $60 times 252 trading days a year? Could you imagine giving up 15 grand a year because you got scared, because you didn't trust, because you decided to change your plan? So that was 3 minutes. Moving a stop to lock in profit in the middle of nowhere. No reason to exit, but I'm just going to arbitrarily move a stop. Guys, they're going to hit it almost every time. It's like they have cameras. 5 minutes. Exiting late, hitting a fib, not choosing to take profits, hoping it breaks instead of getting paid at the area. 7 minutes. Trading against the trend. 10. Trading against an area. That means trading in determination conditions. 15 minutes. 15 minutes. Of course I will, Wayne. And then trading against trend and direction. Out of the pros room. That's what this room used to be called 20 years ago, was the pros room. Because you had to earn your seat in this room by participating, posting charts, and showing an understanding so that you wouldn't go into a room with people that had done the work and slow the class down. That's kind of how Nexgen rolled back in the day. I'm a little more loving than that. But this was all done. And guys, this is great. And all it is reminding you that rules are important. Rules are a big deal. Learn how to follow them. Hold yourself accountable. Hold yourself accountable. One of the best things you can do. why trading against area and direction. Thrown out of the room. So I'll share this picture. How to Commit Financial Suicide, One Easy Step by John Novak. Only one page has any information. That's all you need. All the others are blank. Chapter 1, warning sign your friends are in trouble. They are trading against strong triggers, which means they're trading against the trend. Chapter 2, warning signs your friends are not paying attention. They trade into termination conditions. Seek help immediately. Wayne has already proven in this room that you can fight the trend a little bit with the right pattern. But for you new users, these are the two most common mistakes. These are the two that pull the most money out of accounts. Learn how to beat that. Learn how to trade with the trend. Learn how to not trade into areas. Learn how to respect when there's no momentum on the chart and just say, you know what, it might not be my trade, but it's coming. Crude oil fought for 4 hours. And now we have odds favorable momentum and a clear path. And all we can hope is that they give us an entry. So we've got about 20 minutes left, guys. Is there something we want to talk about? Miss Trina, how are we doing? Overwhelmed? Underwhelmed? Wishing Wayne would quit chasing you around the house? Whatever. Understand that by day three, you're going to be like, oh, that makes sense. Oh my gosh, that's that momentum. Hold it, that's that termination he was talking about. And then you'll start piecing them together. Yeah. Drinking through the firehouse and the hose. So you're right where you're supposed to be. Don't put the pressure on yourself to be any further along on day one. Give yourself a little grace. That's my wife's favorite phrase. Give yourself a little grace. You're brand new. It's okay to be. Good lessons today, though. Some great lessons today on management, on chart reading, on definitions. I think we saw a lot of great examples how clear path and momentum creates huge opportunity. Miss Jen, NASDAQ, everything's up. Not quite the best momentum, but you cleared the fibs. So instead of just jumping in at the area and fighting those triggers, you get in on the correct side. Nicely done. Beautiful trade, Jen. I love your patience on this one. And they get you a couple bars every time. NASDAQ's fast. But it sure beats getting in and hoping, doesn't it? NASDAQ traders, fighting these triggers rarely works out. You guys want to see a cool trick? You want to see something neat? I'm going to show you guys something cool. Some of you have seen it. Some of you have forgotten it. But I want you to see this. I am one tick above it, Jen. So, like in this particular picture, if that's my reversal bar marker, I'm one tick above it because I've had it hit my entry on the reversal bar marker and then just go down more than once. So for me, it's worth the $5 to make sure that it actually prints. I don't give it a few ticks because you want the reversal bar marker, right? You want the close on the correct side. You don't need $15 worth of risk. It either is or it isn't. Either is or it isn't. I forgot what I was doing. Oh, stupid short-term memory. What was I talking about? Oh, I remember. Okay. I'm going to show you guys something cool. I only share this with the cool kids. In a downtrend, as long as price is left of those small triggers, it will continue down. In a downtrend, as long as those bars don't close, meaning a full reversal bar that ends up on the other side of the triggers, it will go down. And then it happens again, And then once it closes above, that's where the retracement happens. In an uptrend, as long as they are left of those triggers until they close below, it's going up. So if you're one of those momentum traders, that's pretty cool. So Junior, as long as these price bars are left of those triggers, it's going to go up. Once you get a reversal bar the other side, once you get a down bar on the wrong side, you don't know how far it's going to go down. Once you get a reversal bar on the wrong side, it may not go down anymore. It might, but this is where it could go up, it could retrace, it could become a trend trade, it could be a reversal, who knows. As long as you're on this side of the triggers, the left side of the triggers, it's going to continue in the direction it's going. Jen gets in on the left side of the triggers. Can't hear me? Guys, give me a Y if you can hear me, please. Okay. So let me tell Junior, because he's new. So hopefully he gets that message. And guys, that's for everybody. If you ever can't hear me, just let me know. And then if you see a bunch of people say yes after, that means that everyone can hear me but you. Just log out and log back in. And it'll help. I get that. So hopefully he gets that. Because I can't tell him because he can't hear me. Dagnabbit. There's Wayne's entry. Wayne just got in on the way back up. One of the things that happens too, guys, is I start to learn your patterns. Awesome, Junior. Perfect. I start to learn your patterns. I start to recognize what you're doing and what your plan is. And it's pretty cool because I'll begin to notice also when you go outside of your plan. So Junior, what I was saying, that as long as I'm left of these small triggers, it's going to go down until it closes on the other side. And then I don't know what's going to happen. As long as it's left, it goes down. Once it closes above it, that's where the retracement happens. Once it's left, it goes up and it doesn't go down until you get the close on the wrong side. Do you see it? So you can use this if you're using momentum trades or if you're wondering if you can hold for bigger moves. It's a pretty cool little trick. Here, watch this. Momentum, path, 2 ticks above support inside of favorable large triggers. The stop on this particular trade, 1, 2, 3, 4, 5, is 7 ticks. I have momentum. I'm coming from a strong bottom. It pulled back to that fib right at the bottom of the triggers. My initial stop is 5 ticks below the bottom of those triggers, guys. This does not guarantee a win. What it means is that I have a pattern that has been proven to win more than it loses. The other thing about this particular pattern is the market has been range bound for 6 hours. But I'm not going to put my opinion in there. I'm willing to take the loser. I'm willing to take the loser if they can come get me. If they can't, I'll stay in the trade until my first target's hit. Look at that. They tried to come get me, didn't they? But the language of the KISS plan kept me safe. So now, according to the KISS plan, if I get a reversal bar, it says I put my stop 2 ticks below the reversal bar, but it's already there. So guys, there's nothing for me to do. It either hits my first target or it stops me out. That's it. Those are my only options. That's what the KISS plan says. And if I focus on this number in that box, it's going to drive me freaking nuts. But with this look on the large chart, I'll risk $140 all day long. Won't think twice about it. Doesn't faze me. But if they want my money, they're going to have to come get me. Otherwise, they're going to go up to that first target. They're going to go up to 72.85. Are you guys with me so far? So KISS plan management is all we're doing. Define my entry. Initial stop, first movement, first target. Guys, I'm just following the plan that I give you guys every day. How many of you jumped ship? How many of you got scared because it went 3 ticks below that area? They got to come get me. My rules have been proven to win more than they lose. My stop has been defined in my plan, and it's my obligation to follow my plan, to build trust in my plan. Guys, if this number freaks you out, go to properties and just put none. Don't watch the numbers. All you're doing is following a plan. It's either going to go up or it's not. I'm not in control of that. I'm in control of whether or not my rules are met. I'm in control of whether or not I follow my plan for management. A lot of opportunity for fearful exits here so far. Hamid, how many divergences does it take to keep me out of a high probability trend trade? Do you remember? 3. And it did go lower, didn't it? It went all the way to the bottom of the retracement zone. It went all the way to the areas at the bottom of the retracement zone. It did go lower. Does that make sense? It takes 3 of these to keep me out with this look. Awesome. You're welcome. Always ask the questions. I will answer every one of them. Boaz, odds favorable, clear path, perfect entry. Man, that one didn't go. Didn't make it the distance. Absolutely beautiful entry. Could have made your 100 and gone break even, but you got a couple ticks on it. Nice job. Where are we at? We didn't get stopped out yet, guys. How cool is that? Remember, one of the reasons that $100 is there is because we want to get accustomed to getting paid. We want to get used to taking profits. We want to understand that we're never going to be in control of the market. And if there's an opportunity to grab $100, grab it. You'll find more trades. If you couldn't find more trades, so many of you wouldn't be posting so many pictures in my room. Nanda, do you remember this from last week where we got in the perfect trade and then it just stalled out and made us sit and sweat? It's doing it again. It's doing it again. But my rules say, one of the most powerful phrases in day trading, my rules say that I can't do anything until my first target is hit. And if it never gets hit, they're going to have to come back. Why, Steve? Strong bottom, but I've got odds favorable and a clear path. I've got the perfect entry. This is just bonus, right? That strong bottom is like just a little bit of bonus. I feel good about it. Guys, I don't care what happens next. It's not my job to worry about that. It's my job to follow rules. You know what's cool is my $200 target is below that fib, below that area that may stop the market. That makes me feel good too. What if $200 was right here? Could we take it and move it below an area that could stop the market? Would it be okay to only take $180 on a trade? I think it would be. Let's use our chart reading too. Price pulled back to support. All my triggers are above. Doesn't that blue fib represent a termination condition saying no short trades? That makes me feel good too. Language will wiggle its way into everything you see and do. Do you think it's any coincidence that they're struggling right at a key area? Decisions are made at key areas. I don't know what the decision's going to be, but it's more likely to go up than down because of the momentum. It's more likely. Doesn't mean that it will. But if this one doesn't win, it's acceptable losses. It's 20 to 30%. Crude oil inventories comes out in 14 minutes. They got me. They got me. Does it mean that this trade isn't a trade anymore? No, it means that's how much I was willing to risk on this trade. What if they gave me a reversal bar up so I could redefine? Could I take this trade again based on the large chart? What do you think? Would it still qualify? Would it still fit the rules? That's a decision that you can only you can make. Some people say one and done. Some people say nothing changed, they just got me. Assholes. But it's still a great look if they go up from here. So you'll kind of go that direction a little bit. But there just wasn't any reason to put any more risk than that on this trade. The small crowd won. They ate their Wheaties. They pushed lower than where all of my advantages were. I don't feel bad about it. I wouldn't be the least bit surprised if it went back up, but I'm not going to fight it twice from the wrong side of things. We got a couple minutes, guys. What do you want to talk about? I hate taking losers in front of you because I know that some of you are like, man, you could if you wanted to, Nanda. Does it fit rule number 3? Taking a trade from here. This is all I want you to get. Does it fit rule number 3? No. I'm on the wrong side of the triggers. I'm where the market shouldn't go. What if they printed a reversal bar, Nanda? What if they bounced up, got back inside of the zone, traded with direction and momentum? Maybe. I might be willing to give that a go. But I'm going to force them to go the direction that I want them to go. I'm not going to hope that they go that way. Strong bottom, odds favorable, easy pullback, money, no room to targets, let them break, easy money, boom. Beautiful, Wayne. Guys, check it out. Strong bottom, trading above the area, getting out at the area. Letting the area break, trading from the area, getting to the area. Wayne, thank goodness you knew where these areas were. Kept you out of some ugly little retracements. Great job, dude. Beautiful trade. Beautiful trade. Yeah, and oil inventories is coming up, guys. And a lot of times when oil inventories is coming up, they'll jockey for position. They'll try to get into a good spot. That's what you witnessed here for 4 hours. Was everybody in the world saying, you know what, let's wait and see what they do? And some guy with deep pockets said, you know what, let's push it up here in case it sucks, because then we'll get a better price to short. That's what you're seeing right now. You're seeing the people that control the market imposing their will. Nanda, we're going to take that reversal bar entry if it gives it to us, just to see what happens. I want everyone to realize this is not a high probability trend trade anymore. This is the second chance at one that failed. Holiday, FOMC, inventories, yeah. But man, there's been so much opportunity, Morgan. If you were in front of it following rules, there was a lot of opportunity. If you weren't in front of it, you probably missed it. If you second guessed your rules, you might have missed it. If you weren't looking at the right market at the right time, you might have missed it. We're going to see how Nanda does with letting it go in the direction. This is Nanda's trade. You okay with that, Nanda? How are we going to manage it? Are we going to KISS plan manage it? 100, 200? Stop behind the reversal bar if we get it? This is fun. Why do I have to be in control, right? I'll let one of you guys own the trade. Tell me how to manage it. Yours is a $200 target. So 78, we have to make it to 98. So Nanda, I have to let price get to the other side of the area that could stop the market. I want to make sure I'm hearing you right. Mark, I know 97 could stop the market, but I need you to put the target a tick beyond it because that's what my target is. And if I don't make $200, I'd rather lose everything. Is that right? Nanda, would you be willing to only make 180 on this one and get out before trouble? Because I don't know if you noticed, trouble loves to hold. Up to you. I have no opinion. May not even get an entry. Crude oil inventories at noon. Noon is when crude oil typically slows down. Who knows? Guys, I'm not telling you to take a trade. This is not me telling you to take a trade. This is Nanda saying, Mark, this is my simulated practice, let's have discussion trade. There's absolutely no risk on the table because it's only simulator. And there's a lesson here, and we're just teaching lessons because this is an educational room. I would never tell you guys to get in the market. I couldn't live with myself if you took a loser because I told you to enter the market. I would be sad-faced for the whole day. You'll stop at the synthetic? Okay. So Nanda says, you know what, Mark? We'll put 2 contracts just below the fib and see if they want to go. What would take you out of this trade before it gets there? 3 divergences? What about a second lower divergence? Right on. Not your trade, Wayne. This one belongs to Nanda. We'll see if we can get you a trade tomorrow. So first one didn't work. And this one is saying, you know what? I think there might have been a couple sellers with a little extra giddy up. So if the market goes in the direction of momentum, if the market goes in the direction of a clear path, I'm willing to take a shot. It doesn't mean you're going to win the second shot. Hell, you might take 2 losers. This one's got way more risk than the first one did. This one's got $260 worth of risk, not $140 like the last one. So you better believe in that large chart if you took this one. And on that, we'll come back to it. Termination, momentum, some ugly triggers, a lot of retracement zones there. That's a big gap on retracement zones. Wayne, you would put 1 below divergence because that represents trouble and 1 below the fib because that represents where the market may stop. I don't disagree with that at all. Not everybody's going to have the same plan. That's the beauty of what we do. You guys remember what Grandpa said, right? Grandpa said, thank goodness everyone doesn't think the same or everybody would be chasing Grandma. That's what my grandpa said. Thank goodness. Trading is like your palate, guys. Some of you love apple pie. I hate it. Some of you love strawberry ice cream. I hate it. Ugh. Not hate. Hate's a strong word. Everybody's different. Some of you are cool leaving $1,000 risk on a trade. I can't do that. I don't have the stomach for it. Some of you are comfortable not getting paid at areas. Some of you don't care if it's a bounce inside of the triggers or not. Some of you, all of you, are going to do this differently based on your ability to read the indicators. So in my world, just to give you guys a little insight, in my world, because this is a second shot, if I got a second lower divergence, me personally, I wouldn't re-enter without confirmation, which means that I can get rid of some risk. I can put my stop where that lower divergence would be true. Does that make sense, everybody? A second lower divergence, more often than not, means the market's probably going to push down and take out this pivot. That's a little more advanced management, using a second divergence to manage your trades. You guys will create your own. That's a little insight into how my management plan looks. If it never happens, I don't ever have to worry about it. And yeah, no trade. But there's a little bit about that second divergence if you guys are interested. There's a little snippet on it. So I'm going to close out because inventories is about to happen and my classroom is done, guys.